It's 9 a.m. live from the Nasdaq market site in New York City. I'm Shauna Smith alongside Brad Smith, and this is Yahoo Finance Live. Here is your morning rundown. All eyes are on the Fed's key inflation metric, the core PCE rate of inflation, rising a soft 0.1% last month, slightly below expectations. Interesting stuff for the Fed to mull over ahead of their November rate decision. It is also the last trading day of the third quarter. Yep, time certainly does fly.
Plus, it's crunch time. Still no word on whether Congress will be able to successfully cut a last-minute deal to avert a shutdown, now less than 2 days away. But the odds aren't looking good. A GOP stopgap bill is expected to fail in the House today. All eyes are on Kevin McCarthy. Can he figure out a compromise before midnight on Sunday?
Embracing for an update, UAW President Shawn Fain is going live around 10 a.m. Eastern time this morning with an update on the auto workers strike. If no major progress is made, the union saying that it is expected to expand to more plants. A strike, a tough day certainly to be a big three automaker.
Well, today's morning driver, all eyes are on the Federal Reserve's preferred inflation gauge, PCE. The report came in lower than expected, a reassuring sign amid fears of further rate hikes. Overall, PCE rose just 0.4% month over month and 3.5% year over year. Core PCE, excluding food and energy, rose 0.1% on a monthly basis and 3.9% year over year. Now, even as we continue to think about how the Fed is weighing all of the data going into their November meeting, of course, still higher for longer has been much of the discussion that the markets have had to evaluate. And even as we're looking at the futures here this morning and continuing to evaluate where investors will continue to place emphasis on some of the economic data going forward, futures right now, at least looking at this and putting a bit of a positive spin on it as we're higher fractionally across the board right now.
Yeah, certainly there, Brad. And taking a look at what some of the street strategists are saying in terms of a reaction to this. Chris Rupke, the chief economist at Forward Bond, saying that Fed officials got everything they wanted in this report. When you take into account the consumer spending numbers in here, slowing to just 0.1% in August from a 0.6% move to the upside here in July, 0.3% move in June. So consumers look to be getting a bit more cautious when it comes to some of their spending patterns and exactly what they are buying. They're buying fewer durable and non-durable goods here in August. So we talk about how the Fed is going to look at this. Clearly, their fight with inflation is far from over. They certainly still do have a way to go. But in terms of what they were hoping for, maybe the best way to put that in this report, this is a pretty strong report and shows that their policy is working and continues to work.
Yeah, and this comes after some of the data that we had gotten earlier this week. You think back to the conference board data and really continuing to give us a little bit more inclination about where the consumer is perhaps losing a little bit of that positivity and perhaps staring further out and saying, okay, how can we best position our household balance sheets and for businesses out there, what a potential recession could mean for them. And so with that probability easing up for the next 12 months here as to when we would see a recession, this is starting to show up in even more data points as of right now. And even in some of the earnings that we're going to be breaking down over the course of today's show as well, where retailers are having to figure out, okay, on the lower income or mid or even high income, where there is some moderation, at least in some of the spending propensity as consumers do pull back in select categories here. Discretionary has been one that's of focus. We had an interesting conversation on that yesterday as well.
Yeah, I mean, but also we got to remember that there's still so much uncertainty out there, right? When, given the fact that, yes, the Fed is making some progress when it comes to inflation, there certainly is still that risk out there about the likelihood or possibility, maybe is the better way to put it, that we could fall into a recession. But we still have the UAW strike. We're expecting to get an update on that from Shawn Fain in just about an hour from now. And you also take into account that the government could shut down if a deal is not reached before the deadline tomorrow night at midnight. So a couple of factors here could obviously really change the calculation, really change how the Fed is looking at the economy and, of course, what that would then hold for policy here going forward. But as far as the core PCE report, the number that we got out this morning, better than what the street was looking for and also really showing some progress there from the Fed. Well, the Fed's favorite inflation gauge, core PCE, headed lower in August, a reassuring sign as investors and economists anticipate higher for longer rates. Joining us now, we want to bring in Mark Zandi, Moody's Analytics chief economist. Mark, always great to talk to you. So first, just your reaction to this print that we got, the better than expected core PCE number.
Yeah, I was listening to your commentary, Sean. It's good, about as good as you could expect. I mean, 0.1, that's really a marvelous number. I mean, I'm sure it's overstating the case. I don't think inflation's all the way back into the Fed's target quite yet, but I think all the trend lines here look good. And spending remains resilient. Obviously it slowed a bit from the stronger numbers we were getting in the summer, but that's okay. I think consumers continue to do their part. Real consumer spending year over year is about 2%. That's exactly what you'd want, right? It's enough to keep the economy moving forward, but not so strong that it would feign inflationary pressure. So a great report.
And all of this considered, too, Mark, when we think about going into next week and some of the employment data that we're going to be set to get as well, how does the Fed kind of marry together the consumer reads that we've got over the course of this week with that employment data that's set to come and really kind of use that as their guiding post going into that November meeting?
Yeah, I forgot we're getting employment next week. It really is that it's already upon us. Well, the job growth is slowing on cue. Feels like abstracting from the monthly vagaries of the data. We're kind of sitting around 150,000 per month. It's well below what it was a year ago or 2 years ago. Again, slowing and moving in the right direction. I suspect it's going to slow further here. I think given underlying labor force growth, we're going to need job growth that's kind of between 50 and 100K. So I think that's where we're headed. But so far, so good. Everything feels like it's sticking to script. I think all of this is enough to suggest that the Fed is finished raising interest rates. I think the bar is pretty high for them to cut rates. They'll have to be confident that inflation is getting back to their target. But I think we're moving in that direction. So it all feels pretty good to me.
Mark, what do you think the timing looks like for a potential rate cut?
Well, Shauna, in our forecast, we have the first rate cut next June of 2024, because by that point in time, inflation it probably won't be back to the Fed's target, but it will be clearly headed in that direction. And I think Fed officials can forecast with a high degree of confidence that we'll get there by, say, the end of 24 going into 2025. I don't think they're going to cut rates as they suggested at the last FOMC meetings. I don't think they're going to cut rates quickly once they do begin cutting rates. Maybe a quarter point, couple quarter point rate cuts per quarter. So it's going to take a while to get the funds rate back down to something that's more consistent with its kind of long run equilibrium R star. By the way, just one other quick point, that equilibrium rate, that rate that's consistent with monetary policy neither supporting or restraining growth, it's probably a bit higher than we've come to expect. Forecasts by the Fed put it around 2.5%. My guess is it's probably closer to 3% at this point. So rates will be cut slowly, and when the cutting is over, rates will probably be a little bit higher than they had been, before the pandemic.
Mark, we're going to be watching later on today for a press conference from the UAW, the United Auto Workers Union here. And when you think about how the different negotiations that have played out over the course of this year, whether it be the UAW, whether it be the writers, whether it be what we had already seen with UPS and making sure that they had a new contract, how does that all factor into some of the consumption expenditures data as well that continues to tick higher actually here? We saw that move higher just a little bit, fractions of a percent, but at the same time, all of this is something that the Fed keeps an eye on because it's related directly to wages that are being negotiated as well here, and some of that being put back into the economy.
Yeah, Brad, I sense a theme. You're trying to connect the dots all the way back to the consumer. Everything's connected back to appropriately so. The American consumer kind of drives the train. I think all the labor market actions, you mentioned the UAW strike, the actor-writer strike, and there's others, just goes to the strength of the labor market. We've been in a tight labor market for a long time, and I think the balance of power between workers and their employers has shifted in favor of workers. And they're saying, hey, I want to get paid more, particularly in the context of this higher inflation we've had over the past 3 years. And they're getting it. If you look at overall wage growth, it is moderating, it is coming back in, but it is now above the rate of inflation. So-called real wage growth is positive, and that's a positive for consumers, right? So their purchasing power is now improving. You go back a year or 2 years ago when inflation was taken off and wage growth was still muted, they took it on the chin. Real wages were declining, but fortunately they're now rising, and that is really key to keeping the consumers, doing their part and keeping the economy moving forward. So, I think the labor market actions is just symptomatic of that tight labor market and that relatively strong wage growth.
Mark, we also got the uncertainty when it comes to the government shutdown. Time is ticking. The deadline's tomorrow night at midnight. And when it comes to what is playing out right now, you have the House and you have the Senate advancing their own separate plans up until this point. What do you think is the most likely outcome from this?
Well, I think it's pretty certain they're going to shut down. It's hard to see a path forward without a shutdown here. And I've seen a lot of shutdowns in my day, and typically when you talk to folks in Washington, they've got a pretty good sense of how the shutdowns are going to kind of play out and how it's what the path forward is to ending it. I don't get that sense this go around. I think there's a lot of confusion, which makes me nervous that this shutdown can go on for longer. If it's a couple, 3 weeks, that would be typical. No big deal. Obviously, it's a big deal for the government employees that are furloughed. That'd probably be about a million employees. But other than those folks, I don't think it's a big deal. If it's a month, that's kind of on par with the longest we've had in history, the one we experienced back in 2018-19. Then things start to go off the rails. The things that government does that's really key to making things work efficiently start to break. But again, from a macroeconomic perspective, pretty small. But if it goes on much longer than that, then I think the disruptions become quite significant. Everything from a potential home buyer not being able to get flood insurance and close on their loan to the EPA not being able to certify the operations of an electric utility plant and disrupts the electric grid. So I think if it goes on for that much longer, then does some damage.
And at what point would agencies, firms, Moody's even, have to think about it impacting the U.S. credit rating?
Well, I'm not in the rating agency, so I can't comment directly on the rating. But it's pretty obvious that the shutdown just highlights the dysfunction in Washington, and that's on top of the kerfuffle and the drama over the Treasury debt limit. That's on top of our obvious, very serious long-term fiscal problems. I mean, under current tax and spending policy, our deficits and debt are going to continue to rise. It's not sustainable. We have to change that. And if we don't, then, I think our viability, our ability to pay back in a timely way is going to be questioned, and reasonably so.
Mark, thanks so much for taking the time here with us this morning to really help break down all of these different matters. Mark Zandi, Moody's Analytics Chief Economist. Mark, great to speak with you as always.
Take care.
Thank you. You too. Some breaking news out this morning. California's longest serving Senator Dianne Feinstein, the oldest member of the Senate, has passed away at 90 years old. Yahoo Finance's Rick Newman is here with us. Rick, the significance of this, and of course now as many people will think about the balance of power in Washington, still kind of just who this person was for so many in California, but then even more so in Washington as well.
It's not going to change the balance of power in the Senate. She's a Democrat from a Democratic state. The governor of California, Gavin Newsom, will appoint her replacement. That may take a few weeks, especially if there's a government shutdown. I have not run the drill on how you do this if there's a government shutdown. But unless there's some kind of super close vote within the next few weeks or a month, it shouldn't affect anything in Congress in terms of balance of power. Dianne Feinstein was a giant of politics. She was the first female mayor of San Francisco, one of the first female senators. She had a storied career. We have to mention the fact that she hung on to her job. She refused to leave her job, even as there were mounting signs that she was incapable of doing the job. And this does underscore this problem we seem to have in Washington, D.C., which is nobody retires, and we've got a gerontocracy running the government. Obviously, a concern with some voters related to Joe Biden. Now he's 80, and he appears fit and up to the job of president, but he would be 86 when he finishes a second term if he gets that far. 4 years younger than Dianne Feinstein was, and you just cannot sidestep the question of age and whether it's better for the country for members of Congress and leaders in the government to retire with dignity at a retirement age, at a kind of a normal retirement age, instead of just hanging on forever. But there will be many memorials for Senator Feinstein and her remarkable career.
Certainly, there has been a lot of talk, a lot of chatter recently just about that potential retirement age and if it makes sense in terms of term limits. But Rick, let's talk a little bit more just about, or what we know maybe about her potential successor. Do we have any names, and I guess how that process would work?
It's straightforward. It is the governor appoints the successor. And I don't have a list of names, Shauna. I will in probably the moment I get off air here, but there will be no shortage of contenders. It will include members of the House of Representatives from Congress. It could include some mayors in California. And this is important, really important, because if you're an appointee, obviously you have to be reelected in an election the next time it comes around. But if that makes you an incumbent, and whoever gets this appointment will have the power of incumbency when it's time to get reelected, and probably have a great shot at reelection. So again, there's no chance this is going to change balance of power in the Senate. It will be a Democrat for sure, but there must be dozens of people right now who are lobbying for the job. And in fact, they probably have been lobbying the job for a long time, given how old Senator Feinstein was, and the fact that it was fairly apparent that she would be leaving at some point.
Senator Feinstein, a trailblazer, certainly for women in politics. Rick, thanks.
Hi, guys.
Nike shares are hitting the ground running this morning after easing concerns about a slowdown in China, and they also saw inventories fall back 10% compared to a year ago during its fiscal first quarter. For more on this, we want to bring in Josh Schaefer. And Josh, taking a look at the move pre-market here, up 10%. The street pretty pleased with this.
Yeah, Sean, the street was definitely pleased. And I mean, there was some easy beats you saw just in the results as far as what was pushing Nike stock forward ahead of the call yesterday. You saw a beat just simply on EPS, and then you also saw a gross margin beat, and you saw Nike perform well in certain areas abroad, while North American sales actually came in a little bit lower than expected. But getting into some of the key numbers here that I think is why you're seeing basically a 10% jump in Nike shares before we see the market open today, you had a gross margin beat. That's been a closely followed metric for Nike, and for that to come in higher than expected is a big deal. Then you take a look at inventories. We've been following inventories at Nike for basically several years now because they've had an issue there. Inventories down 10%, so they're sort of past that. And then I was closely tracking the stock's movement during the call yesterday, and it was interesting to see where we really saw those big legs up. One of those moments was when Nike CFO Matthew Friend started talking about the consumer. He said, "We continue to see consumer demand for our brands and for our products to be very, very strong. The consumer is proving to be resilient." That was the biggest takeaway for me from this Nike call. You had the stock down about 25% coming into the report. There had been a lot of worries about, is the consumer slowing down? Is there going to be problems in China? And Nike came out and flat out said, not for us. Maybe there's a consumer slowdown happening, but we're not guiding down for the holiday quarter. We feel good about where things are at. Nike COO mentioning that he had been in China over the last twice over the last 4 months. He feels confident about what's going on in China, no matter what happens with the macro. He feels like people are still going to be buying sporting goods. Nike's still going to be able to succeed there. And they even mentioned that Foot Locker sales are falling, but guess what? A single retailer only accounts for about mid-single digit sales for Nike. They sort of diversified that wholesale group, maybe a little bit more than some on the street had expected. A lot of people have been watching declining sales at Foot Locker and saying that might weigh on Nike. Nike also saying that headwind might not be as big as people thought either. And we're starting to see, of course, the stock pop a little bit before we open the bell today.
Yeah, taking a look at Nike shares this morning here with about 10 minutes until the start of today's trade. Shares up 10%. Josh, thanks for breaking this down for us. Let's continue the conversation as Nike is looking for a turnaround on the back of its first quarter results, with shares down over 20% so far this year. Of course, today's early activity are going to help cut into that a little bit. For more on the state of Nike, we're joined by Adrian Yee, Barclays Consumer Discretionary Senior Analyst here. Adrian, great to speak with you as always on all things revolving around this space, and especially Nike here on the day. Just kind of broad read here. Were you impressed? Key takeaway from Nike's earnings?
This print was definitely a relief. There was so much negativity that going into the print, whether it was concern over greater China growth, concern over the wholesale destocking portion of the cycle, concern over DTC. And I think that the notion, as Josh had mentioned, that the consumer is still buying this brand. When we see a consumer pullback, right, oftentimes we see a crunch in dollars. And so people start to kick out sort of their second, third, or maybe their fourth favorite brand, but their favorite brands they continue to spend at. And I think that's what you're seeing with the power of, Nike being sort of the number one brand, both domestically and globally.
And Adrian, because of those high inventory levels over the last couple of quarters, we've seen Nike really being forced to discount their products, a lot of promotional activity. Is this a sign that Nike's going to have a bit more pricing power heading into the holidays?
So very good question. They actually said their ASPs were up. So that is testament to the fact that during the pandemic, the past couple of years, they have, along with everybody else, raised their initial price points. Those are sticking as they're seeing deflation on the costing side of things. It's not really happening yet. So there's still another tail quarter of product input costs that are still higher. But they talked about great visibility in this fiscal back half of the year on freight recapture. And now that the inventory is clean, you can now start to see some of that promotional recapture that we always talk about once you have sales growing faster than inventory.
You've got the CEO of Nike, John Donahoe, saying that he's visiting international presences and specifically China multiple times during the quarter here. What does that tell you about the significance and the growth story that they're anticipating to see within that region?
China is extraordinarily important to all retailers that are kind of expanding globally. It was extremely important to Nike pre-pandemic. Remember, at pre-pandemic, they had an algorithm of 15% or more compound annual growth from the market. It was going to be or on track to be nearly 25% of the business by, say, 2025. Now, the pandemic changed all of that, right? China is about 15% of total sales now, so well off that mark. And what's interesting is China actually did miss consensus expectations, which were for 18% growth, but it came in at 12%. And it came in basically on the back of stronger full price sales in a market that's highly, highly promotional among the domestics. Anta, Li-Ning, they're very promotional. So they're kind of stretching away from the pack and they're actually gaining market share. That's a very strong testament to the brand within China. Let's also not forget, globally, they have a $4 billion demand creation budget that they can sort of laser target at will, depending on the market. And right now, they're going back into the China market with aggressive demand creation.
Adrian, what do you think this report and what you were saying just in terms of consumers sticking with Nike, willing to spend on certain brand names, what does it tell us about some of the other names within this space that do still have partnerships with Nike? Are we going to see a bit of a turnaround here maybe over the coming quarters?
So this is interesting. Remember, their channel partners operate on a 6-month sort of look ahead, right? Mm-hmm. The order book, the wholesale bookings that Nike sees today are a representation of how the retailers are feeling, say, one season now, so 6 months from now. So we're right in the thick of destocking. The other thing that I want to point out here, that destocking where the wholesalers, they're on the negative side, right, of that kind of restocking effort that was made last year. Nike talked very much about controlling the sell-in, that the sell-through at their retail channel partners is still high single digit. And they are guiding for effectively flattish, right? Flattish to down wholesale sales actually, but flattish total sales for the quarter. So they're actually controlling what they call the marketplace. They're trying to maintain the health of that brand. They don't want it to get away from them. And so, if you think about and you believe what the management's saying, they're saying, look, we're doing this because we want to be healthy. We're in control here. This is not the tail wagging the dog. This is us in control of what the channel can have. We actually forecast that we'll get through this wholesale cycle, which is just kind of like a bullwhip effect, right? Stocking and then destocking. Probably by mid-2024, we're expecting the wholesale channel, their retail partners, to need to start to restock. Because remember, these retail partners, CKS, Foot Locker, their growth trajectory is based on what hot product they can get from Nike, right, going forward.
We've heard a lot of companies try to make this pivot and shift and kind of tell the narrative differently about what kind of company they are. Nike is in the business of sport, but in some instances, we've heard themselves say that we're also a technology company in certain instances. How would you look at Nike and assess and apply a multiple to them? Is it kind of a company that carries more of a multiple synonymous with a company that is in technology or is in, just footwear and apparel? How would you define them?
So number one, they are a brand. Historically, when Nike has been quote unquote on fire, right, and doing all the right things, they've traded at a 30, forward PE multiple. Today, they're sitting at close to trough levels at about 23 times. So I would say that they certainly, in their good days, get a growth multiple. If we're talking about can they metamorphosize into a tech multiple kind of valuation, I would say that they're using technology to enhance the brand and the customer experience. But this, at the end of the day, it's a footwear brand that's selling hot merchandise at full price, and it engages with the consumer. And technology should be an aid. It should not be the driving force of the company. Within their DTC, right, the direct to consumer, they are planning to lead with digital. So you see that they are actually using sort of the DKS marketplace in the stores. They're not leading by opening very high CapEx expensive stores. They're leading through their digital channel, through the Sneakers app, and through Nike.com. And that's how we think there's a very symbiotic relationship between how technology can enhance the brand, make them smarter, create product that the consumer wants.
All right, Nike shares, again, up just about 10% here ahead of the opening bell. Adrienne Yee, always great to get your perspective. Barclays Consumer Discretionary Senior Analyst. Keep right here on Yahoo Finance. We've got all your market action ahead live from the Nasdaq market site. We'll be right back. All right, we've got the opening bell on Wall Street, doing a quick check of the markets, sponsored by Tasty Trade. We're seeing a move higher here this morning following that better than expected inflation data print out ahead of the bell this morning. You have the Dow up pretty significantly here at the open, as well as the S&P and the Nasdaq. Jared Blickery standing by at the big board for a closer look at some of the movement that we're seeing, Jared.
Yeah, so it looks like I'm still waiting for some quotes to come in from yesterday, but it does look like energy is now in the red, not really seeing anything else down there. We are getting a reprieve in the bond market from those yields that have been screaming higher. Well, they backed off a little bit today, and I think the market has just kind of taken a break, maybe a quiet Friday in this now autumnal season. Here we can see Apple bouncing back. Just want to graph that quickly because I was showing yesterday how it just broke down below multi-month support here. So just crawling back some of those losses. Not in the clear, though, till it gets right above this potential resistance line, let's say 180. Want to see a close above there for Apple. Microsoft up, so is NVIDIA, Amazon, and the tech sector looking nice. Let's take a look at some of our leaders. And China, KWEB, that is a Chinese internet ETF. That is up the most. That's up 2.3%, followed by meme stocks, that ETF, solar, innovation, IPOs, chip stocks, looks like transportation's in there too, and retail. So a broad swath just kind of taking advantage of perhaps lower liquidity on a Friday when we can actually claw back some of those losses from earlier in the week when things were a little bit more pressing. Here's the bank sector. We got JP Morgan in the green for about 0.5%. Bank America up about 1% as well. And I did say energy was that lone sector in the red, and really seeing that play out here. We did see crude hit multi-month highs yesterday, maybe backing off a little bit, but Exxon down about 0.7%, Chevron down about 0.25%. And let's take a look at the meme stocks. Haven't done that in a while, and this kind of gives a flavor for the fringing side of the market here. And if you got some hot money flows that don't go into a stock like Apple, you're going to see more of that come in here and more of a risk on sign. So not seeing too much dark green. It looks like Peloton up 3%, so is Carvana. Both of those stocks mired in deep, deep red territory if you're going to go to a longer term chart. And then let me just get some of the opening. Here we go. Travel sector. We do see mostly green here. Carnival Cruise Line's up about 3%. Haven't charted this one in a while, but you can see down 13% over the last 3 months, guys.
All right, Jared, thanks so much. We're going to continue the conversation on some of those interesting moves that we've seen over the third quarter here. Let's take a look at some of the market movers of more imminent news. We've got Carnival Cruise Line, Carnival Corporation shares. You're seeing them move higher by about 2%. The company releasing their Q3 earnings this morning, and analysts saying that they're riding high tide. Robust demand and elevated onboard spelling good news for the cruise company. Yahoo Finance's very own Brian Sazzi is interviewing Josh Weinstein, who is the Carnival Corporation CEO and president today. You can catch that at 3 o'clock here. But even as we continue to evaluate what the broader sentiment is for some of the cruise line operators, they have been some of the outperformers over the course of this year. And a larger question of whether or not these re-engagement campaigns where you had customers that were going to set sail last year, maybe the year prior, when they were looking for more guidance from the CDC, looking for the all clear that you would see full capacity on these cruise line operators and not just a kind of gated capacity plus restrictions on top of that. I think for the cruise line operators, they've done a good job of attempting to make sure that in those re-engagement campaigns, not only do you have a customer that has been pent up waiting to get into these experiences, not me, not going on a cruise, but not only just waiting to get onto the cruise, but also looking to spend more while they are in that experience too, and that's paid off.
Yeah, and that's critical here for the cruise lines going forward. You mentioned their outperformance this year. They're among the best performers in the S&P since the start of the year. When you take a look at the performance of Carnival, when you take a look at the performance of one of their rivals, Royal Caribbean, Carnival's up more than 80% since the start of the year. Royal Caribbean up more than 90%. So we certainly have seen a massive bounce back in these stocks since the start of the year. But digging a little bit deeper into this report, getting a beat on both the top and bottom lines here for the company. Revenue up nearly 60%, 59% on a year-over-year basis. Adjusted EPS coming in at 86 cents a share. Passenger cruise days at 25.8 million. That's up 46% from just about a year ago. And some of the commentary here from Weinstein, who we'll hear from later on this afternoon on Yahoo Finance. But Weinstein saying that the outperformance was driven by strength in demand, with both our North America and Australia segment as well as the Europe segment equally outperforming expectations. He also went on to say that with less remaining inventory to sell, despite a 5% increase in capacity, we are well positioned to drive pricing higher and also deliver strong yield improvement in 2024. And we're seeing that reflected in the price move here at the open, with the stock up just another 4% here, right above $15 a share. But going back, Brad, to the point that you were making here, it all comes down to the consumer, their willingness to spend not only on buying the trips and getting on board of these cruise ships, but also the spending and what we're seeing exactly play out once they're on the ship.
I think it also says that at least at this point in time, too, you're looking at a Carnival that's in a much better position to perhaps pull back on some of the marketing spend in re-engagement campaigns, or just trying to attract net new customers as well as things start to normalize, or at least eliminate some of the chop on the high seas, if you will.
All right, let's talk about another mover here over the last several months. And today's the last trading day of the third quarter. So we want to take a look at one of the outperformers here, and that is Meta. Meta stock up just about 6% since the start of the third quarter, bringing its year-to-date rally to more than 150%. A couple of things driving this. One, the year of efficiency. Mark Zuckerberg has been talking about it for quite some time. They also had a number of new products out from Meta in the last couple of months. Most recently, we heard about the smart glasses with Ray-Ban this week, also a new Quest 3, also the launch of several AI products, and exactly Meta's role in AI and the hype and the rally surrounding that excitement here since the start of the year. But a lot of people, a lot of investors, I think, entered the year questioning Meta's vision, right? Whether or not we were going to see this return to Meta, and Zuckerberg and the team certainly, I think, exceeding many analyst expectations.
I think a lot of analysts are just happy with them saying, okay, all right, it's not going to be the metaverse like what you were talking about before, and advertised on in the Super Bowl, where we're walking around, don't know if we got legs or not, trying to figure out what the future of that is, or if there still is one in that direction. But at least in the metaverse, or at least in the augmented reality verse that you can think about here going forward, I think this glass product is a real step forward right now from Meta Platforms. You're taking a look at shares over the course of this quarter, one of the better performers among mega cap tech stocks. You'd seen a few of those slip up, most notably during August and September. So closing out the third quarter and having some of a bumpy ride or a hard landing to it. But then at the end of the day, for Meta to come out here and be one of the outperformers and really look at this year of efficiency, look at the new product that, through partnership with Ray-Ban, at least here for right now, this is perhaps one of the first glasses products that I've said, you know, this has got something to it. And I think a lot of the early reactions are synonymous with that. And so investors who are going to do a little bit more digging, perhaps some of the analysts get their hands on this product and give either the yay or nay as to whether or not consumers, and depending upon the price point, will buy into this and be willing to not just make sure that they're still engaging with a Meta platform product, but also continuing to dive further into the ecosystem of products as well. That's going to be key here. The glasses, they look pretty decent. I'm just going to say it. I have been hesitant about any type of kind of wearable, even on the headset front. But these glasses look decent, and I guess it's because I already own a pair of Ray-Bans.
I got to try them on before I'm sold first. But I do like the look of them.
You know, just while we're talking about some of the outperformers here, I know we mentioned Meta, Carvana. Jared had brought that up earlier on. Year to date, Carvana is up 817% year to date. It's crazy. It's almost got some type of meme activity to it, but 60% added during Q3. It was also looking at Rivian. That's up 44% quarter to date, or at least in this quarter, that's where it ended out. 25% year to date. So some interesting kind of stallions that you've seen over the third quarter activity here. All right, we got to cook with some gas here. Blue Apron shares, they are hot this morning. They are moving higher by, check this out, 130-something% right now. I'm squinting to try and see what that activity is, but it's up a lot. Shares, this is moving higher, coming after the company announcing that they reached a deal to be acquired by Wonder Group. Wonder, a food delivery startup, intends to purchase the company for $13 per share, giving Blue Apron a roughly $103 million valuation. Okay. Let's take a step back here. You got to remember, Blue Apron has done 2 reverse stock splits. One of them prior to this year's, that was a 1-for-12 stock split. That was 2023's. Prior to that, I believe there was a 1-for-15 stock split that they had. The company went public back in 2017 for $10 a share. The issue that they ran into, and you could immediately tell on the day that they went public that they were struggling to gain a lot of investor fanfare when they opened at $10 and closed at $10. What was also announced? Amazon was acquiring Whole Foods at about the same time. I think that was a little north of $13 billion deal. All this considered, you had a rough, rocky road for Blue Apron from the jump that they got into the market, and they have sputtered and just declined. And so with that in mind, this is a pennies on the dollar type of deal that Wonder is essentially able to get here when you back out both of those reverse stock splits at the end of the day.
Yeah, I think it's fair to say that ever since this company went public, it's almost been a disaster. They've been trying to figure out exactly how to grow their business, how to further penetrate here in terms of the consumer growth, and they haven't been able to do it. And when you take into account exactly what has played out since the company did go public back in June of 2017 to where it is now, it did have a buzzy start when it launched just over a decade ago, but ever since, they've run up into a couple of issues, some being out of their control given what happened during the pandemic, but supply chain issues, inflation, a number of things that have certainly hindered the company's growth here over the last several years. It was either a deal like this or the company would not have existed, right? They've been searching for some sort of option now, strategic option, the best fit here for their business for quite some time. What Wonder Group does with Blue Apron, I think, is a big question up until this point. And according to the reports and what we've seen now so far out this morning, they're going to continue here for the company to do their business like they have been. Wonder plans to continue Blue Apron's operations, serving customers nationwide under that Blue Apron brand. But how they grow their customer base. Have you ever tried it?
No.
So I have.
Blue Apron, have you? Yeah.
Years ago,
Okay.
right? When we were talking about all that buzz back in 2012, 2013.
What was your favorite meal that you had?
You know, there was a lasagna. Actually, it was pretty good. I was living by myself at the time. I was single. I think the lasagna I made, I'm not kidding, I think it might have lasted me 2 weeks.
Really?
So it was a good bang for my buck at that point. But my biggest issue was it still took a heck of a long time to cook the meals.
Really?
And if I'm doing a meal kit service, maybe they have fixed it since then. Again, this is 10 years ago, and I'm sure the company has developed their recipes in that time. That was my big issue, and that's why I didn't continue the service.
The landscape, the environment was just wide. You had Sunbasket, you had Blue Apron, you had Purple Carrot with the Tom Brady TB12 meals. You had HelloFresh. So many options for consumers to choose from, and the acquisition costs for customers were just going to continue to be sky high when you've got that type of environment, and Blue Apron ultimately here finding a savior in the Wonder Group.
All right, Brad, let's pivot to one of the gold standards of retailers, and that's literally, let's take a look at Costco. Shares are on the move this morning, but the warehouse store, it's selling gold bars. We're seeing a loss at just about 1/10%. But let's talk about gold bars because this is a headline that's certainly taken off. The company saying that within hours, reportedly, that the bars go for sale. They go for sale for a little less than $1,900 per ounce, which is about the same rate that gold is worth. And as of this morning, also this week, Costco reported its quarterly earnings topping Wall Street expectations. But let's get back to those gold bars because that's what we want to talk about. We heard from Costco CFO Richard Galanti on an investor call earlier this week saying that he's gotten a couple calls about people seeing this online. They want to get in on the gold ounce bars here, and he was saying that they actually sell out within a couple of hours. It's a limit to 2 per member, but I think this is a sign of the times right now. Maybe the fact that some people are a little bit worried about what the next several months or a couple of years could look like.
Yeah, possibly. Look, we had one of our newsroom famed producers running through different area codes, zip codes, just trying to figure out where we could get one of these gold bars at. And if you figure out, viewers out there, because
they go fast.
They go fast.
They go very fast,
and
within hours.
You can only buy 2.
Yeah.
It's a limit 2 per customer here. So we were looking across all of these different area codes. We got as far down as Charlotte, still found nothing, at least online right now. So we're going to continue to go back to the drawing board on that after the show here. But I think for Costco, what this also kind of spells out is that you have a company that is so wide ranged in their assortment of products and able to generate fanfare in everything from a 6-foot teddy bear all the way up to a gold bar, at least on the purchase scale there, and what the value of it is. Not saying the teddy bear is not valuable, but at the end of the day here, I think for Costco, what they're going to need to continue to do for the consumer is show that they can be an inflationary hedge, buying in bulk, even when there is uncertainty for some consumers out there. And so that's going to be a key. Also, they've been giving out, of course, some of the deals or annexing deals to membership for gas. That also a hedge that a lot of consumers would look across right now. But I love what you were saying earlier. I would love to just get that printed on a T-shirt. Let's talk about gold bars. That should be a T-shirt. That should
Let's
be a
talk about gold bars.
That should be a Yahoo Finance hat. We need to start a merchandise business.
Well, you can tell by the demand out there. Certainly, people are buying them up at a very fast rate. Like you said, we couldn't find anything. Where'd you go as far south as Richmond? You said?
Charlotte, North Carolina.
North Carolina.
Yeah. We're gonna try Atlanta after the show.
All right, you guys can let us know. Write in. Let us know if you guys find it because we're on the hunt for some of those.
I'll Venmo you.
All right, we're gonna keep right here on Yahoo Finance live from the Nasdaq market site. Stay tuned. You're watching us live on this Friday morning. Stocks are set for sharp losses in September as today marks the last trading day of the month and the last trading day of the third quarter. Higher oil prices, the Fed's higher for longer tone, and even China's lackluster recovery, all among the factors weighing on the markets here for the past several weeks. Joining us now to discuss how this sets us up here for the fourth quarter and into 2024, we want to bring in Steve Sosnick. He's Interactive Brokers Chief Strategist. Steve, it's good to see you. So help us sum up the trading action that we've seen over the last couple of weeks, the downside move that we've seen in the markets in the month of September, what that tells us that investors should be bracing for in the final quarter of the year.
Hi, Sean. It's great to see you. I think right now the way that I would characterize September is part of it is seasonality. It's just that it's normal for investors to sort of reassess risks as we get into the August-September period. It's ahead of year end, and that's the way people think. And this time, very specifically, I think while we were starting to finally reckon with the fact that the bond yields had been rising steadily throughout the year, it wasn't really until the FOMC meeting when it really hit home that rates would be, if not higher for longer, let's call them high for longer, or elevated for longer. And that was kind of an unpleasant splash of cold water in the face of the markets. And I think that's what we were reckoning with, because we had gotten pretty complacent. And I think that, risk finally the appreciation of risk finally returned to the market this month.
Yeah, if they really wanted to splash cold water, they could have just stepped outside today. It's monsooning, Steve. But at the end of the day, as we think about the economic data that the Fed is yet to really continue to evaluate here, and of course the Fed speak that's going to take place between now and November, what would you look for any type of change in tenor that investors should be paying close attention to?
It's not clear to me what's going to change their tone. Now, I think this morning's core PCE deflator is the kind of thing that could change the tone, because it really does show that there's progress being made in one of the Fed's, probably in the Fed's most important economic inflation measure. But there's other problems out there. Oil prices are going up, which has definitely been a headwind this month. And it'll be interesting to see in a few minutes, how those start to affect University of Michigan inflationary expectations, which is not necessarily something that I normally look too heavily at, but it's been very tied to oil. It's always very tied to oil and gas prices. So these are the sort of things, if we really start to see inflation come in, if we really start to see that the idea of whether it's a soft landing, a no landing, a harder landing, some clarity in that regard would be really helpful. I think part of the problem we have here is, because the market was so fixated on interest rate cuts in 2024, I think it lost sight of the fact that, you're only going to really get interest rate cuts if this economic circumstances warrant it. You sometimes have to be very careful what you wish for. And I think that's been the message that the market's been dealing with over the last couple of weeks.
So, Steve, what does that mean for investor portfolios in terms of how they should be positioned here over the next several months? What are some of the moves that you're making now?
I first of all, if you're nervous, there is an alternative, and I have seen a lot of investors realizing that you can park your money at 5% for essentially no risk in T-bills and CDs, et cetera. Bank accounts, even 4 or 5%, money markets, et cetera. So I think that's been a big change. We'd been programmed to believe, which was true, that there is no alternative. That cash is trash, but cash has a value now. And so I think if you're nervous, it's not the worst thing to park some money in cash or cash equivalents, short-term fixed income. You're getting some yield. And actually, if inflation is kind of quiet, we're actually getting some real yield, which means you're actually not even losing money vis-a-vis inflation. I think it's right also to reassess the risks rewards. If the market's reassessing its risk reward, you should be doing the same. Are you piled into a bunch of the same narrow leadership that has been leading the market higher? You got to reassess whether you think that's the place to be for the coming few months. Does the rest of the market play? Do they mean revert? Does the rest of the market play catch up to the high flyers, or worse, do the high flyers play catch up to the broader market? And these are the things we're going to have to wrestle with. And the problem I have is it's tough to be too constructive with rates where they are now. If there's some improvement, particularly on the long end of the curve, that may be something good to watch for. But another key thing to keep in mind is, as we see the relationship between the 2-year and the 10-year yields normalize, meaning that the 10-year yields start to climb up toward and eventually potentially above the 2 years. The recessions don't start until the yield curve normalizes. So that's also a big worry, is the fact that we've actually disinverted so quickly.
Steve, we're closing the books on Q3 2023, and it wasn't good for the U.S. major averages here. And there were a few bright spots, but all in all, if there was any top story from Q3 that you were looking across, what was that, and how does it potentially influence your decision making going into Q4, or even to the extent that you've got some top ideas that are beginning to brew as we get into 2024?
I think to me, it was earlier this month, if you'd asked me the question, I would have said, why is the VIX just sort of around 13 and nobody paying attention to the fact that markets are selling off, to the fact that rates have been rising, et cetera, et cetera. Then all of a sudden, boom, we went from, call it 13.5 to 19. We're sort of back around the 16 level today after a couple of days of decent moves higher. I think the way that the switch flipped from complacency to, again, this more normal appreciation of risk, that to me is really what's characterized this quarter was finally we started to notice. And the question for me in the fourth quarter rather, is do we start to keep this more normal view of risk? Remember, VIX around 18, 19 is normal, not high. And so do we start to have this more normal appreciation of risk, or do we try to just go back to our old ways of ignoring, there's one thing to climb the wall of worry, it's another thing to sort of ignore it. And I think that's really the questions we have to reckon with. That's what we've been reckoning with and what we have to reckon with.
Steve, would love to continue the conversation. We got to leave things right there for today. Steve Sosnick, Interactive Brokers Chief Strategist. Have a great weekend, Steve.
You too, Brad. Take care.
Thanks. Well, everyone, we're live from the Nasdaq. Unless a deal is made at the 11th hour, government funding is set to run out on midnight on Sunday. A compromise appears unlikely at this point. Hardline Republicans vowing to reject any short-term funding deal that doesn't satisfy their demands. And Americans are taking notice. In a recent Monmouth University poll, 43% would blame Republicans if the government shuts down, compared to 21% who blame Democrats. Now, in this Capitol Hill standoff, who stands to lose the most and who could actually emerge a winner? Rick Newman joins us now with what he's keeping on his radar. Hey, Rick.
Hey, guys. I've actually been enjoying, for once, the many emails the Biden White House has been sending out to the members of the press on their press list. First of all, they have a countdown clock. They're saying whatever the number of hours and days is until the Republicans completely wreck the functioning of the U.S. government. They tell you all the pain and heartache that's going to cause. And then they keep sending out these split screen emails saying, here are the clowns in the Republican-controlled House of Representatives. They're holding impeachment hearings on nothing. They are talking about all the damage they're going to do to the U.S. economy as if this is a good thing. And meanwhile, here's President Biden. He's meeting with world leaders. He's giving speeches on why it's important to defend democracy. He's on the picket line with striking workers. And normally I just blow this stuff off, but I think the Biden White House actually has a point on this. I mean, this is just a total clown show among Republicans. And it's not even Republicans fighting with Democrats in the House. It's Republicans punching themselves in the face. So I think most Americans are not paying attention to this because they have real lives and this is not their problem. But they will start paying attention when the government actually shuts down, which it seems like it's going to do. And as has always been the case in the past, this is just a loser for Republicans. Do they care? We're talking about 12 to 15 of the most extreme Republicans in the House. They don't care. These are like the snotty, entitled Republicans who think the government is their plaything. And they're going to shut down the government. And it's going to follow a familiar script, which is President Biden is going to come out looking better and Republicans are going to come out looking worse.
Rick, what about Speaker McCarthy? Because there certainly has been lots of talk just about from the far right, from the group that you were just talking about there, that if he in fact does try to strike any sort of deal, there will be calls to oust him. Just talk about the predicament that he's in right now, and I guess what any sort of deal or lack of a deal could mean specifically for him.
I mean, this is kind of what it's all about. This is the inside baseball of this shutdown, and I've been reluctant to write anything about this and give these guys any more attention than they deserve, which is frankly zero, except they are holding the U.S. government hostage, so we have to deal with that. McCarthy will not. It would be easy to fund the government if McCarthy would make a deal with Democrats to fund the government. But if McCarthy did that, then he's got such a slim majority in his vote to remain Speaker of the House that the Republicans could recall him as Speaker, and he would lose his job as Speaker of the House. So just to remind people what this is all about, it only takes a simple majority of the members of the House of Representatives to pass the laws to fund the government. McCarthy could get most of the Democrats to agree with those laws and enough Republicans to agree, as long as it was like normal spending. But you've got 12 to 15 extreme Republicans saying, no, we demand draconian cuts because that's what we think the American people want, which is not what the American people want, by the way. And so Democrats aren't going to sign off on that. Republicans can't get enough votes to do it. And here we are. It's ridiculous.
Here we are, just over 24 hours to go here. What is it? 1 day, 14 hours until that government shutdown deadline. All right, Rick, thanks.
Hi, guys.
We've got all your market action ahead live from the Nasdaq market site. Stay tuned. You're watching Yahoo Finance.
Hey, I'm Brad Smith alongside Shauna Smith at the Nasdaq market site in New York City. You're watching Yahoo Finance Live. We're about 30 minutes into the start of the trading day to wrap up Q3 and the week. Here's how things are shaping up. It's the last trading day of September and of the third quarter. Stocks, they're higher as the Fed's key inflation gauge that shows prices cooling in August. Reassuring sign as investors have feared sticky inflation causing higher for longer rates.
Taking a look at some of the individual names, let's start the weekend with Bud. Shares of Anheuser-Busch on the move to the upside today. Bank of America upgrading the stock from neutral to buy and also setting their price target to $68 a share. You can see it just above 55 today. It's certainly been a tough year for the company. Bud Light facing a longer than expected boycott after transgender influencer Dylan Mulvaney promoted the beer on Instagram. Today, though, we're looking at moves of just about 3% to the upside.
And Buzz. Bumble. Yeah, the stock is also climbing higher today after Loop Capital Markets upgraded it to a buy. Firms saying that the dating app's strong cash balance and free cash flow generation will help protect its balance sheet and calling the stock de-risked.
Brinker is also among the winners today. Stifel upgrading the stock to a buy. The analyst there saying that recently they attended an investor meeting and was happy with the turnaround efforts with the Chili's chain. That was enough for the upgrade there on Brinker. We're looking at a move also of about 3%. Now let's get to the market commentary of the day. Barclays strategists saying that they believe stocks will remain sensitive to the rate market even if third quarter results show strong earnings. Now, in a note to clients, they caution that rates likely remaining higher for longer. The bond market will experience some disruptions and become, quote, disorderly, and equities will not be immune to those moves. Well, Barclays then saying that they still expect better than expected earnings that could stabilize oversold markets, but notes that sentiment has recently turned negative. Still, though, the firm maintains an overweight position on value stocks.
Well, switching gears here, weekly jobless claims came in extremely low in the latest data, indicating the labor market is remaining extremely resilient, even as rate pressures mount. But our next guest says that there are underlying concerns that most people are not paying attention to. Joining us now, we've got Lakshman Achuthan, who is the co-founder of the Economic Cycle Research Institute. Lakshman, great to have you here on the day here. Good morning. First and foremost, just kind of looking through some of the economic data we've gotten this week, how does that change, or where does that kind of spell out where we are in this broader cycle right now?
Well, I think just as you said, labor market's holding in there. So the firings are not mounting at this point, but the hirings have certainly come down quite sharply. And when we look at the labor market, there's lots of signs of it hollowing out. We put out a piece on that on our website recently about all these cyclical components of the labor market really hollowing out. So temporary jobs down over 7.5%, then level. So you're letting go of people who aren't full-time employees. You're reducing the work week as a manager as the demand is slowing. It all comes down to what's the consumer doing, right? That's about 70% of the economy. And there we have some new data, right? We have the GDP data this week, the revision, I should say, to Q2, which showed a pretty decent come down in the consumption part of it. It originally had printed at around 3.8% consumption. It's all the way down to 0.8% growth in consumption. And a lot of that was in the service sector. Remember, after COVID, we bought all those goods and then we pivoted to buying services. And then now that growth rate's really coming down. So this slowing in consumption has managers who don't want to fire anyone, letting go of temp workers, letting go of reducing the work week. All the cyclically sensitive discretionary stuff in the jobs market is really hollowing out. And then today, this morning, we got some stuff in August, right? Some August spending data that shows that spending continues to ease. Savings rates are down. And so you kind of pivot into these headlines that you're seeing every morning. There's plenty of things to worry about, right? Government shutdown, student debt moratorium is over, some strikes, which are keeping wages kind of sticky. The Fed doesn't like that. And then lo and behold, oil is still pretty high, or you're going higher. And so your gas prices are not giving you a break. So I think the recent data is we have this kind of, the sand is shifting. It's a little weak under our feet here.
Yeah, so given that, then, I guess, what does that tell us about the direction of the economy? Lots of calls, or more calls, I should say, not a lot, more calls about the fact that we might see a recession. How much more likely do you think that could be, given the fact that the consumer, there's some signs that the consumer's weakening, and then there's still a number of reasons, high oil prices being one of them, to be a bit concerned?
Yeah, I think the trend is not our friend here, either in the overall economy or in jobs growth in particular. Look, we've been expecting a hard rather than a soft landing. That continues to be our base case. When we look for the alternative, could we be wrong? And we're looking, is there a soft landing? Is there a reacceleration? That's not showing up in the data. For the most part, in all the types of forward-looking data that we can look at about the direction of the economy, it's mostly the market-related stuff that have been kind of optimistic. But a lot of that has been predicated on, hey, the Fed's over. And the Fed is not over, right? It's higher for longer. Lots of people have been coming or realizing that more recently. And even if the pace of inflation is easing, which I think it is for the overall, the level isn't, right? We're all stuck with these higher, the level of prices being quite a bit higher. It's restrictive. And that's why discretionary spending is under pressure. That's why the cyclical slowdown and maybe a hard landing remains, I think, a very active possibility.
Lakshman, we only have about 45 seconds left here, but when you think about how important the labor market data that's coming out next week is going to be to the tone, the tenor of the Fed going into their November meeting, what does that spell out to you?
For the Fed particularly, I don't think you're going to get, I mean, look, it's always a bit of a crapshoot as to what the number is. There's a lot of stuff in there. I think the trend is still decelerating. I don't think you're going to get a weak enough number to give the Fed a break. And so they're going to need to see negative jobs growth for a few months in order for them to ease up a bit. And we're just not there yet. We have a ways to go. So I don't think you get the break from the Fed. And meanwhile, other parts of the curve are going up for a whole bunch of reasons. And so this sounds like more slowing to me for the months ahead.
All right, Lakshman, always great to have you on here in Yahoo Finance. Lakshman Akshuthan, co-founder of Economic Cycle Research Institute. Thanks. Have a good weekend.
You too.
Keep right here on Yahoo Finance. We've got all your market action ahead live from the Nasdaq market site. We'll be right back. We're here at the Nasdaq market site in New York City. Let's do a quick check of the markets sponsored by Tasty Trade. We're looking at gains across the board. The Dow up just about 56 points, so off the highs of the morning. S&P up about 0.5%. The Nasdaq, though, continuing to be the outperformer, up just over 1%. Well, time is running out for lawmakers. The government shutdown is looking more and more likely amid little progress on talks inside the Beltway. And Americans are bracing for the impact. The Senate put forward a bipartisan proposal to avert a shutdown, but that hit a roadblock in the House. And Speaker McCarthy, well, he appears to lack the votes that he needs to pass his own stopgap measure. Let's break it all down, figure out where we stand and what this means for Americans. We want to bring in Bill Kristol, the Bulwark editor at large and also host of Conversations with Bill Kristol, and Greg Valliere, AGF Investment Chief U.S. Strategist. Great to see you both. Bill, let me start with you. Just in terms of the likelihood of a shutdown, is there any way that you see Congress being able to get a deal done ahead of tomorrow night's deadline?
I mean, it seems unlikely because Speaker McCarthy will not bring the bill that had passed the Senate, a 77-19. Majority of Republicans even voted for that, a 45-day continuing resolution, pretty much just government funding, continuing as it has been. There's a majority in the House for that. They'd get 70, 80, 90 Republican votes for that, and all the Democrats. And McCarthy won't bring it to the floor. So it's pretty astounding. In the past, the shutdowns have been about actual policy disagreements on pretty big issues. Gingrich, Clinton, on Medicare. I mean, you go through them. Some of them weren't quite so big, but they were real disagreements. This is kind of a Seinfeld-like shutdown over nothing because McCarthy is scared of losing his speakership.
Greg, when you think about any type of impact that would overflow into the equity markets if we were not able to see a deal, what would that look like?
If it's a short shutdown, I think the impact would be minor. But if this goes on for several weeks or, God forbid, even months, then I think it would be a headwind for the overall economy. And I would throw out one thing that would be an irritant for the Federal Reserve, which is data dependent. The Fed is not going to probably be able to get the unemployment report next Friday because the Bureau of Labor Statistics, which puts out that and also puts out the inflation report, will also be shut down. This is a great annoyance to the Fed as they try to set monetary policy.
So, Greg, just to clarify that for everyone out there, that happens as soon as the government shutdowns, just in terms of the data that they will not have access for. And when you talk about the length of this being so critical when we're trying to determine the impact for Americans on the economy, on the market, I guess how long does a shutdown need to go before you get a little bit more concerned about the impact?
A week from today, if we don't have an unemployment report next Friday, that will be a sign of that's one of many things. There's perhaps more serious issues, money for food for women, infants, and children. There are a lot of programs that could start to run out of money. But in terms of the most visible one right away, it's going to be the economic data.
So, Bill, as you're continuing to kind of really cover everything that is surrounding this shutdown, the of course machinations of the however you want to classify what takes place inside the Beltway, and then all the way into the economic impact that later takes place. We were talking to Moody's earlier, and Mark Zandi telling us, and of course he's in a different part of Moody's than the credit rating side, but we could potentially see a hit to the U.S. credit rating. What would be the significance of that from your purview?
I mean, usually the people who are causing the shutdown back off when they see something really dangerous happening. But I want to emphasize Greg's point. I mean, these are real government programs that are going to stop. And whether they're helping women with little kids or whether they're keeping national parks open or allowing NIH to go about doing further research, they're real people who work for the government. And you can dump on bureaucrats all they want, but this is their job and many of them work hard at it and their families depend on it. And the attitude of just treating it as a cavalier thing that, we're going to show them and we're going to shut it down, I think by itself, that's very bad for the country and sends a signal that the people who are one of the parties, at least, that's helping to govern this country is not serious about government. So, now eventually the pressure mounts and eventually presumably the Republicans we see. But again, I want to emphasize the asymmetric character of this. Biden, sometimes presidents provoke shutdowns. Clinton enjoyed the shutdown with Gingrich and he really benefited from it politically. Biden, the Democratic majority of the Senate, they have done nothing to provoke this. They have passed the most plain vanilla continuing resolution in the Senate. Biden's endorsed it that would just keep things going for 45 days so they could work things out. So the rationale for opposing that, I think, is really, there is no real rationale except they want to shut down the government.
Greg, is this a lose-lose situation for everyone involved, for both parties, and obviously for Americans?
Certainly for the Republicans. They tend to lose these battles, and this will not be any exception, because the fight is among themselves. It is, Bill said, it had nothing really to do with the White House. So no, I think this is more than just a pox on both your houses. I think this is a pox on the Republicans.
Bill and Greg, perhaps for both of you, when you think about the biggest part of this, of any type of resolution that needs to come forward, actually, you know what, take a step back here. Is it about time to have a law in place that just allows for us not to have a shutdown?
Yes, I would think so. I mean, you'd need a law that would say, they would then have to say, what does government spending go on? What level does it go on at? If it went on at current levels, the Republicans would say, oh no, we want to cut government. But that is in effect what the 45-day, just to be clear, what the Senate and the administration are for, what the Democrats are for, is sort of what you're saying, right? Just past 45-day extension of current programs.
And
you know,
Greg,
there's one irony
answer
here.
that same if you want. Yeah, go ahead, Greg.
Yeah, I was just going to throw out one irony, and that is the final deal has to involve Democrats. I can't for the life of me envision a final deal without Democrats. So it's just a matter of time before McCarthy and other Republicans have to throw in the towel and agree that without Democrats, this could go on for months.
Wow.
But the question is, like it's like, does McCarthy mind if the economy gets, they're pretty good at blaming Biden and the Democrats. If you look at the polls, people have a bit of a pox on both houses attitude, even if it's not justified. Do some Republicans think this damages Biden, damages the incumbent administration? Perhaps.
And there are many Republicans.
You go ahead, Greg.
Oh, I just add real quickly, there are many Republicans who I think would welcome this. It's the burn the house down caucus who would welcome something this dysfunctional. I just think that Moody's investment and Fitch and all of the investment raters are going to look at this and conclude that we're so dysfunctional in Washington, there's going to have to be a credit downgrade.
Well, Bill, I'll end it here with you. What do you think this tells us just about the future of the Republican Party, given the fact that we have such a divided party, the fact that there is a group on the far right who are essentially, it seems to be looking to shut the government down? What does that tell us just about what the GOP is going to look like in the years to come?
And a few months ago, the McCarthy backed off from testing the debt limit, and people thought, okay, maybe at the end of the day, it's a responsible party. But here we have them going for a shutdown. If it's a few days, it's obviously not a total disaster. But again, the leading presidential candidate is Donald Trump, and he's called for a shutdown. So the sort of, the irresponsibility caucus is strong in the Republican Party.
All right, Bill Kristol, the Bulwark editor at large and host of Conversations with Bill Kristol, and Greg Valliere, who is the AGF Investment Chief U.S. Strategist. Gentlemen, thanks so much for joining us here today to help break down and ultimately discuss what we hope doesn't happen, but is looking amazingly imminent at this point in terms of a government shutdown. We appreciate the time.
Thanks.
Thanks. Well, on the final trading day of September, stocks are clawing back some of September's losses as investors look ahead to the fourth quarter. Here to help break down all the market action, we've got Yahoo Finance's Jared Blickery with a special guest. Hey, Jared.
Hi there. We have Alyssa Corum today from Investors Business Daily, and we're talking about the Nasdaq. Now, Alyssa, we are looking at a downtrend. This is over the last 3 months in the Nasdaq. We just had the worst month of the year in September. Wondering what you're seeing from a technical point of view.
So the recent undercut of the mid-August low, I think that's actually really constructive. Of course, no one wants to see the market go down. We want to be making money, but that actually shakes out the weak holders. So we are now in the early stages of a rally attempt on day 3, but we don't want to try to just call a bottom, right? Don't want to pick a bottom that can be risky. We want to see a confirmation of a change in trend. So what I'm looking for is what we call a follow-through day. So that happens on at least day 4 of a rally attempt, the earliest. It could take a couple weeks or months to play out, but of course we want the sooner the better.
And
We're on day 3 now.
We had a couple follow-through days earlier in the year. One of these was in early January, worked out. The other was in late August. That didn't work out because, as you just said, we undercut those lows.
Exactly.
How does an investor use these to help get into the market and also avoid some of the bad, the false positives?
Yeah, and we had one in around late May as well. So I would say this signal, no one has a crystal ball, right? But it's putting the odds in your favor. So if you can get a confirmation that institutions are coming back into the market, that's what we're looking for. We're looking for a couple of up days in a row accompanied by increasing volume. That signals, okay, the institutions are moving back in. Maybe the waters are a little safer. Not every big rally has that really early on. Some of them do fail, but every big rally does start with one of these follow-through days.
All right, and just to be clear, we got to wait till day 4, so it's not even possible to have one today, and yesterday was not one just yet.
Not quite yet, almost.
All right, we're going to talk about Meta here. Looks like a bunch of sideways on this chart, but let's put a year to date because this is a stock that has been on fire. Given the market cap, you can't help but notice this.
Exactly. I think this is arguably the best looking Magnificent 7 stock. If you track relative performance versus the S&P 500, that outperformance is definitely there. And with a lot of tech stocks that have been selling off since July, this one has held up really, really well. And now that volatility is contracting as of late, it's having a good week this week, trading right around 300 or so, actually using that as a launching pad. Now getting above that level. So we had a little bit of a shakeout. Now we're moving up. You could draw a trend line from the highs, the declining tops trend line, potentially actionable here, but we don't have that market confirmation signal just yet. So be careful. You always want to use a stop loss.
All right, very important there. Always manage your risk. Also want to move on to another ticker, Baker Hughes. This is a year to date, up 20%. Oil services. What do you see in the technicals?
So a little different. I favor tech stocks, but you can't deny when something like it's been on fire. It's been outperforming. So whereas a lot of, again, the tech stocks have had a tough last couple of months, energy has really come into focus, and this one's been trading nicely. It's big, it's liquid, it has strong fundamentals. Last quarter earnings, super strong. So pulling back here today, of course, we know the energy stocks tied to the underlying commodity there, but this could have some potential. I think on the downside, you want to be looking at that 34, 35 level for some support. 38 on the upside. If it can get above that recent high, I think it could have up until 40 to where the next potential resistance level would be.
All right, there you go. Also, I want to talk about emerging markets. We don't necessarily talk about this all the time, especially in terms of technicals, but I'm looking at EEM. This is the iShares MSCI Emerging Markets ETF. This is heavily weighted toward China, so I'll just throw out that caveat. But when you take a look over the last 3 years, you can clearly see it's stuck in the bottom end of its range still. Just wondering if you have any thoughts on the technicals in this particular ticker.
Yeah, I mean, you said it, Jared. Looks like it's stuck in the doldrums here, moving sideways. So hey, at least it has a bottom. It's not still going down, so that's a start. But if you're looking at relative performance versus the S&P, this is underperforming. So I say you might as well buy SPY unless it can get out of this consolidation area and start outperforming the S&P, because the goal at the end of the day for active traders, we want to be outperforming the broad market, not underperforming.
Well, I'll say this too. This is a max chart. This goes back about 20 years. This is really a non-trending asset here. I could make the argument that this has been going sideways for quite a long time. Alyssa, I do have a little bit of time. I got less than a minute here. Just wondering what you're thinking about the U.S. dollar index. This is a max chart, but year to date, it's been pretty strong. Does this affect your thinking at all when you're entering trades in the tech sphere, for instance?
Absolutely. I think if you're looking at the dollar and interest rates, there's that inverse correlation that you're seeing. So as long as we're seeing a strong dollar, strong interest rates, that is going to be a wet blanket on the equity market. So we want to see a little bit of relief there. It's definitely a factor to consider. But at the end of the day, it's price that pays. So if you're seeing a strong stock like Meta outperforming the S&P 500, you may want to take a nibble, but again, manage that risk.
I love it when people quote Brian Shannon, only price pays. Alyssa Coram, thank you very much.
Thank you.
All right, thanks, Jared. Thanks, Alyssa. Keep right here on Yahoo Finance. We've got all your market coverage ahead live from the Nasdaq market site. We'll be right back.
Welcome back to Yahoo Finance Live this morning, everyone. Everyone has been keeping an eye on the energy sector lately, with oil prices soaring to their highest levels in more than a year, with some analysts saying that oil prices could hit $100 a barrel soon. This comes with rife global and domestic tensions as both Saudi Arabia and Russia have cut outputs, but also as the U.S. heads into the beginning of its presidential campaign season. So how can investors stay on top of economic and political headwinds impacting the energy markets? Let's bring in Energy Word founder Dan Dicker to discuss more. Dan, for investors that are trying to keep their thumb on the pulse of this, where is the best place for them to continue to start and ultimately evaluate the data that is coming through?
Brad, we got a very interesting kind of place where the oil markets are at right now. And I've been on your show several times. I've been the most bullish guy on oil. Some analysts calling for $100 oil now when I was calling for $100 oil many, many months ago. Now, that being said, there are a lot of technical and headwinds that are in place for the oil market right now. A lot of technical headwinds, and some of this is deep inside the weeds. Fundamentally, oil is as strong as it was when, I spoke to you, in the height of the summertime when oil was $68 a barrel. But now that it's approaching, 92, 93, 94, it seems to me to be way ahead of itself in terms of the cycle and where it's supposed to be. I do see $100 oil coming, but not now. It's way ahead of itself. So we have a tremendous backwardation that's going on in markets, backwardation that we haven't seen since like the financial crisis. We got a 6-month backwardation of $8. I know it sounds deep in the weeds, but it's very wide right now. We have technical indicators that say that oil is well overbought. Up here at $92, $93, $94. And finally, we have traders. And this has been really my bête noire for my entire career. Whenever the specs get very deeply on one side of the trade, they tend to be wrong. And they are as long right now in oil. The ratio of longs to short is as deep as it's almost ever been. And quite frankly, I do not see oil doing much constructively more to the upside until they get, a good spanking for being this long oil, for believing that oil is cheap at $93 when they didn't think it was cheap at 68, not more than 2.5 months ago. So for me, at least right now, I'm telling my clients to really kind of back off of their positions. We've made a lot of money in energy. It's been practically the only subsector of the S&P that's done well over the course of the last 2 months. And I'm telling a lot of my guys to take some money off the table here and not push more in.
So Dan, what level, if you're advising investors right now to take profits, I guess what level does crude need to fall to in order for you to be a buyer again?
Yeah, and this is interesting, Shauna, because, if you are a technical player and you do watch the momentums on trades like this, what happens is that the higher energy goes here, the more of a rubber band gets stretched. So therefore, when it does turn around, when everybody does seek the exit on the trade, the lower it will go back on the downside before you're ready to reshape a portfolio. So my advice right now is to wait to see how far the momentum of traders that have been piling into this oil trade are going to push oil prices before setting a target on where to get back in. But you're welcome to have me on when oil snaps back down into the 80s.
A lot of this, as we were mentioning at the outset of this conversation, Dan, it comes back to some geopolitical tensions here, too. Is there any sign of that abating that would take pressure off of, or at least kind of abate some of the prices here that we've seen oil rise to?
Yeah, you talk about the political thing, Bradley, and that's a big deal because, Joe Biden has used, for example, the Federal Reserve came to his aid during the midterms. And he used the SPR to take some pressure off oil prices during the midterms. And both of those tools seem to me, I don't know how much more the Fed can go in terms of rate hikes to quash oil prices. Maybe they'll go to 7, like Jamie Dimon says. Right now at 5.5, it seems like they've used a lot of their arrows. And certainly the SPR has been drained 44%. Very hard for him to reach into that toolbox. What might save him and what might add some supply into this market here is Iran. they've been ramping up quite a bit, and that's been a surprise. And of course, the relationship between the U.S. and Iran has gotten a little cozier these days than it's been in the past. You know, we had this prisoner swap a couple of weeks ago, and some sanctions have been removed. Some Trump-inspired sanctions have been removed by the Biden administration. Maybe Joe Biden is hoping that the Iranians will come across with another 1 million barrels going into the next election season. I don't know, but for right now, the Saudis and the Russians have really put the screws to supply here, and aside from these technical things that I talk about, fundamentally, the oil market does look very, very strong.
Crude off just about 1% today, but still above $90 a barrel. Dan Dicker, always great to have you on. Thanks for joining for your perspective. We'll keep right here on Yahoo Finance. We've got all your market action ahead live from the Nasdaq market site. We'll be right back.
Welcome back, everyone. We're hearing now from UAW President Shawn Fain as he is announcing even more of the moves that are set to come and are being announced by the UAW, the United Auto Workers Union. We heard from Shawn Fain just last Friday, and so now in a weekly cadence here, we've heard more of the updates. As of right now, they have heard and they have been working day and night, Sean Fain saying, to bargain a record contract. Ford and GM have refused to make meaningful progress, he says, and they said that they're also going to expand the strike to Ford and GM from noon today here. Particularly interesting as we were continuing to listen into some of the early comments that Fain was making at the start of today as well. He said that the war on workers is a rigged fight for decades. It's been the same story: unchecked corporate power, disappearing worker power. The result is massive inequality across our society. To restore the balance of power, and saying that they have to restore the strike. That's what every one of their striking members is doing. So they are continuing to move forward with the announcement of this. You're taking a look at some of the reaction to shares in real time on some of these announcements as well.
Yeah, certainly another strike beginning at a Chicago plant for Ford and also at a Lansing, Michigan plant here for GM. In terms of the expansion that we're looking at now, UAW saying that they're calling on an additional 7,000 Ford and GM members to strike starting at noon today. And when just before Sean Fain started speaking, he was a little bit late, and he said that that was because they made last-minute progress with Stellantis. You can note here that they are not expanding their strike against Stellantis, at least for now. And this comes, Brad, like you were saying, after some of the progress that UAW had said that they had seen with Ford, at least last week, because remember, Ford was spared in terms of the expansion of the strike that we saw when the UAW had 5,600 workers at 38 GM and Stellantis-owned parts distribution centers in 20 states begin to strike and walk off the job just about a week ago. And this is a strike that began back on September 15th when nearly 13,000 auto workers walked out and stopped working at the big three assembly plants in Michigan, in Missouri, and in Ohio. So still, they have not reached a deal with the big three automakers. And as a result of that, even though they have said that they had made significant progress in the talks with Stellantis, we're seeing the strikes continue against the big three and expand when it comes to their strikes with GM and Ford. Just
kind of describing the setting here that we've continued to watch Sean Fain really navigate through. And for the members that he's representing, some of them feeling so encouraged, or at least so motivated as to create a music video, it seems, from one of the members that was started and really kicked off today's press briefing, or not even a press briefing, just really a presidential briefing from UAW President Sean Fain, who last week was wearing camo in a short sleeve shirt. This week, as one of our esteemed kind of viewers has also mentioned, looks more akin to Jake from State Farm. All that considered, you've got considerable movement forward here. At least it seems. Stellantis, as we were taking a look at shares, that is one of the only companies that is holding on to gains right now. And here's why. As you were discussing earlier, they have made additional progress there at Stellantis, not calling on any additional members at Stellantis to strike. And so perhaps there is a little bit of movement that's taking place, but you wonder what Stellantis is negotiating, how they're negotiating differently than Ford and GM right now. Ford and GM still, those shares in the red as of this point in time, and this press briefing continues to go on right now, or this announcement of any updates continues to go on right now. And we will, of course, we'll keep you updated with any additional headlines coming out from Sean Fain of the UAW. All right, well, Apple has reportedly met with Chinese officials over the past few months for conversations about the latest rulings restricting access to many foreign apps on the iPhone App Store. This is according to a report from the Wall Street Journal. Yahoo Finance's tech editor Dan Halley has the details on that. Dan.
That's right, Shauna. This is part of a crackdown that China is doing against foreign apps. Basically, the app developers themselves have to register their apps in China. So think Facebook, Instagram, X, Twitter, whatever we're calling it today. They all have to register within China to be able to be accessed there. Obviously, they don't run their services there, but Chinese citizens will download VPNs, virtual private networks, to get around that so-called Great Firewall to be able to access those apps. And so because of that, China wants these companies to register. The problem is those companies don't want to register, because if they do, then they may have to do some form of data sharing agreement with China, and they're opposed to that. And so as a result, this kind of falls on Apple. If these companies don't register, Apple has to either remove them from the App Store entirely, or could face legal ramifications in China. And so Apple essentially reached out trying to get clarification on this, according to this journal report. And really the issue is how much damage could it do to Apple if some of these apps ended up staying in the App Store? Don't forget, there are still millions of people that access those apps via VPNs. Apple has made concessions to China before regarding the data laws that they have in place, including holding Chinese citizen data in China. And so this could be a broader issue if it cuts into Apple's services revenue through the App Store, but it also could be a problem for Apple as far as relationship goes with China. And they want to ensure that they can keep that in place, not only because of the huge amount of revenue that the country generates for them, whether that's through services or through the sale of devices, but also because that's where the bulk of their manufacturing still resides, and which is why they're continuing to try and move that overseas.
All right. Dan, thanks so much for continuing to track this for us. Some big movements there, big news, of course, surrounding Apple, and we'll continue to keep tabs on shares of AAPL here. Everyone, we've got all your markets action live from the Nasdaq market site straight ahead. Stay tuned. You're watching Yahoo Finance.
Welcome back to Yahoo Finance Live. I'm here live on Capitol Hill, whereas we're just hours away as we await what's going to happen with the government shutdown. Joining me right now is Brendan Peterson, Punchbowl financial services reporter and author of The Vault. So, Brendan, as we know, clock is ticking. Sunday, 12:01 a.m. is when it all comes to a halt here. But what are you hearing so far, the conversations about the likelihood that anything can be done to avert a shutdown at this point?
It seems all but assured at this point that we're going to have a government shutdown. The question is how quickly Congress will come together to eventually have a package that funds the government, even for a short amount of time. Just this morning, we reported that the House Republican CR stopgap bill would fund the government through October 31st. That's something. It's not as long as the Senate's stopgap bill would do, but there's still a lot of red meat policy priorities in that House Republican bill that are probably not going to pass the Senate anyway. So the chambers are too far apart. It doesn't seem like we're going to avert a shutdown at that point between now and that 12:01 deadline.
And when you look at the last shutdown that was 35 days long, do we get a sense when you think of the political climate that we're in now that it could be longer than that?
There's really nothing that you can rule out at this point. When you're thinking about exactly how long past shutdowns have gone, past shutdowns have had discrete policy disagreements, right? Like the 2018 shutdown was really about the border funding and what Trump was trying to do, what House Democrats didn't want, a singular fight. With this, the goalposts keep changing. Republicans cannot make up their mind about what they are actually mad about, whether it's securing the border or abortion policy or Ukraine funding, the list goes on and on, right? It's really just a handful of members within the Republican Party that are gumming up the works here. And so when it comes to like just how long the shutdown's going to drag out, it kind of falls to them as long as Kevin McCarthy continues to try to work with them.
And it's interesting because when you think of where we were in May, you had this bipartisan agreement. Now, as you mentioned, you have a lot of these cross currents coming into play. And when you look on social media and some of these call-in shows, people are frustrated, but they're frustrated at the government as a whole, but then they're bringing in this issue of the border and also funding and aid for Ukraine, saying, why is that aid going to Ukraine instead of going to the American people? It feels like a lot of these cross currents are really getting tied up in something that was already agreed upon in May. Why do you think this is happening?
It's a great question, and it's a question that has reverberated around the Hill for a little while now. I mean, a lot of the conversation revolves around the House Freedom Caucus. A number of them have, if not openly welcomed a shutdown, they have certainly been pining for it. I think there is an expectation that a government shutdown, while it might not reflect great on Republicans, Biden is the head of government, President Joe Biden. He is going to look at least a little bit bad if the government isn't functioning, if workers are not getting paid, if service members are not getting paid as a result of the shutdown. So you have to kind of squint to see the math here. There are titanic risks for both sides, but at this point, like, the fighting has been so concentrated within the Republican Party, it's hard for me to see how they would avoid taking the brunt of the blame here.
And so, as we've been looking at the Wall Street reaction, been relatively muted. They seem to have gotten used to all these shutdowns. At what point does that turn when fiscal policy comes into play, when it comes to how the blame then plays out in fiscal policy?
Right, that's a great question. So when we think about a shutdown, the economic effects seem relatively muted. It takes a long time for a shutdown to affect things like economic output, GDP, that kind of thing. I know the Federal Reserve Chair Jay Powell has said, like, you shave a basis point off here and there after a month or so. But that's not really our top concern. The top concern is the stability and predictability of fiscal spending, right? Federal dollars undergird a lot of the economy one way or the other, right? So if we can't depend on steady streams of income for the next year, that's not how long I expect the shutdown to go, but if we're going to keep going back and forth on this for the duration of while we have divided government in Congress, it's not going to be comfy. It's going to be really unpleasant for people and reporters and politicians and everyone in the middle.
And just very quickly, obviously, the passing of Senator Dianne Feinstein, longest serving woman in the Senate, one of the longest serving senators in U.S. history. What does this do also there for the balance of power and some of these arguments that we're seeing, especially when she was known for her bipartisan efforts?
Yeah, for now, the Democrats are still in control of the Senate. 50 votes plus Kamala Harris as the vice president, tiebreaker vote. We're still in control of the chamber. They don't have to worry about that. But in terms of the current shutdown fight right now, there might be some considerations. There might be, if the Senate's stopgap bill contains immigration policy, you're bumping up the threshold of votes from 50 votes, which if it was just money, we're just funding the government, you only need 50 votes for that. But if you're talking about immigration policy, you're getting up to the 60 vote threshold. At that point, Feinstein's vote would matter. It would always matter, but in this case, it might really matter. So that's going to be something we follow pretty closely in the days and weeks ahead.
Certainly a lot at stake, and obviously a lot of us grieving here for the passing of Senator Feinstein. We appreciate you joining me, Brendan Peterson there from Punchbowl News and from The Vault. Back to you guys at the Nasdaq.
Thanks so much, Michelle. Appreciate that, and much more to come from the Rotunda from Michelle in the next hour. Well, the UAW's Sean Fain just announced more strikes to come from Ford and GM at noon today. Yahoo Finance's Pras Supermanian. He is here with us. He's got the details. Hey, Pras.
Hey, guys. So Sean Fain expanding the strikes, but not to Stellantis, to GM and Ford. He said that they're making some progress with Stellantis with regards to cost of living adjustments and also the authorization to strike at certain plants who are shut down. But basically, this is a big deal because GM again hit by these stand-up strikes, this time hitting GM's Lansing Delta Township plant, which makes the Buick Enclave and Chevrolet Traverse. And then the plant affected by Ford is Ford Chicago Assembly Plant, which makes the Lincoln Aviator and Ford Explorer. So some popular SUVs there that will be sort of shut down here. Sean Fain saying that 7,000 workers will join the additional workers today at 12 p.m. Eastern if progress not made. So the strikes are going to happen there.
And I know might be a little bit too early to tell, but in terms of the production disruption, any idea what that could look like given the fact that an additional 7,000 workers are now on strike? And it seems to be that there's a little hope when it comes to some of the progress that they're seeing with Stellantis. Any idea there as to maybe why they're a little bit more satisfied with what Stellantis has put forward versus what we've heard from GM and Ford?
So Fain's address that today was actually delayed because they just got a counteroffer from Stellantis where they mentioned the fact that they're going to potentially move on those cost of living adjustments and the strike authorizations and other things like potentially, I think, there's something to do with benefits and things like that. So there's some good movement there. But in terms of disruption, again, they've localized it to certain products. So some of these SUVs are going to be affected, but not the big profit truck centers yet. The pickup trucks are still happening. Other GM trucks and Ford trucks are still happening. So that's sort of where they're sort of picking and choosing their surgical kind of movements to where they can strike these plants.
How much of the strike right now is already baked into the stock prices and the movements that we've seen, and how much still has yet to play out from what we know?
I think we've seen the stocks sort of move up and down. We saw the stocks pop up today earlier because there was a Bloomberg report on this, and then sort of now they're adjusting. Stellantis up now because they're not affected by the strike here. So I think we're seeing it's happening in real time, right?
Yeah.
So we've seen estimates that every week that goes on, $100 to $200 million in profit is getting evaporated for the big three based on where they're striking. And of course it expands, it gets worse and worse and worse. So it's hard to quantify, but I think Wall Street probably doing a good job of kind of tweaking and trying to find it in real time where they are right now.
All right, a story that I know you are going to be following very closely here in the coming days. Pras, thanks so much.
Thank you.
That's all for us today from the Nasdaq market site. Rochelle Akufo and Akiko Fujita have you for the next hour. We'll see you next week.
Welcome to Yahoo Finance Live, and happy Friday to all of you. It is 11 a.m. on the East Coast, 8 a.m. on the West. I'm Akiko Fujita with Rochelle Akufo, who's joining us live from Capitol Hill today. Here's what we're watching at this hour. The clock is ticking with the deadline for a government shutdown drawing ever closer. We'll be live from the Rotunda all hour to speak with top lawmakers, including Democratic Congressman James Clyburn. And all eyes on the Fed's key inflation metric, the core PCE rate of inflation, rising a soft 0.1% last month. We're going to break down what this means for the Fed's November rates decision. Plus, UAW announcing more strikes beginning at noon today from Ford and GM. That doesn't include Stellantis. We're going to discuss what this means for the big three car makers. As always, though, we are beginning with a look at the markets. 90 minutes into the trading day, we've got green arrows across the board right now. The Dow up 39 points, the S&P 500 up 21, and the Nasdaq up 133. We've been watching those big three car makers, shares of those three, very closely here on the back of that announcement that came down just a short time ago from the UAW about the expansion in these strikes. Ford and GM getting additional stoppage in two separate plants. Stellantis, though, spared here with the UAW's Sean Fain saying that they have made significant progress on some key issues. We're also watching Treasury yields very much in focus today after the Fed's preferred inflation gauge core PCE showed some signs of progress, and you see the pullback there. The 10-year yield coming off of that high that we haven't seen in more than 15 years, now at 4.52%. Well, we are beginning this hour with the threat of a government shutdown, with federal funding set to run out in just over 24 hours. Republicans now scrambling to vote on a partisan short-term spending bill that's expected to get little support in the Senate. Rochelle is joining us live from the Capitol Rotunda this morning. Rochelle, I've got to ask you, where is the optimism, or is there any optimism on the ground there that this government shutdown can be averted come Saturday?
I mean, I will say the optimism does seem to be running quite thin at the moment of averting a government shutdown. The shutdown is supposed to occur Sunday, 12:01 a.m. if no law is passed. Now, it's interesting because this is a different situation. Usually when there's a government shutdown, it's because there's a specific policy issue. When it was under former President Barack Obama, it was over the Affordable Care Act. When it came to former President Trump, it was about the border wall. It's hard to see where this is coming from at this point, though, considering what was agreed upon in a bipartisan effort back in May. But here we are, counting down the clock at the moment. Some of the issues that continue to be raised, aid over Ukraine, the border crisis as well. A lot of issues coming to the fray, which obviously were supposed to have been settled back in May. So really trying to find out what it is that a lot of these GOP holdouts are really looking for. And so to break down some of this, I'm honored to be joined by Congressman James Clyburn, who's joining us now on this, because a lot of people are wondering what this means for the economy. In terms of some of the vital services, what should the American people know about the economic impact that they can expect here?
Well, thank you very much for having me. First of all, the economic impact would be draconian in a very negative way. The fact of the matter is, decisions were made, agreements were made back in the spring of the year to determine what the top lines would be, and we agreed to that, and they agreed to it. And the Senate, in a very bipartisan way, has been marking up to those numbers. I think the vote was 77 to 19, but the House has decided to break away from that agreement because there's a small number of House members who feel that we ought to cease our movement toward a more perfect union, do away with democratic principles, put in place policies that will undercut the safety of travelers in this country, undercut the supplemental support we give to women, infants, and children. Just do things that put us as a nation, in an isolationist mode by failing to fund Ukraine. We in this country cannot be isolationists. NATO means as much to us as it means to any other country that's a member of it. And for us to put ourselves in the mode to say we're going to go it alone as a country, we can only think about those who can do for themselves, and we will not do anything to support those who rely upon the government to get from day to day. It's just silliness. So what they are agreeing to in order to get a unanimous vote of Republicans, it just doesn't make sense to me. But it also says that the majority of the Republicans who do not agree with this ought to be ashamed of themselves if they allow this to take place.
And one of the proposals that McConnell had put forward was saying, look, if these federal workers don't get to have their pay, Congress shouldn't either. What do you think about that tactic as a way to perhaps pressure them to at least help them understand what it's like when you are furloughed, when you have 1.3 million active military who have 2 paychecks coming up that won't clear?
Well, that's a concept that we all ought to take a hard look at, which means that if you're wealthy as I am, and you have been passed along a fortune to live on, then we ought to allow you to go without pay. It's not going to hurt us. It's only going to hurt those people who bring themselves up into this process, who need to work every day. I'm fine. I'm over 80 years old. I'm fine. But there are a lot of 20-something-year-olds and 30-something-year-olds here who are in public service, and they do have children, and they do have the need for child care, and we are going to say to them, tough on you. It's okay for us who are well-to-do.
And I do want to ask you about some of the cuts, some of the proposed spending cuts. Robert Aderholt, a congressman of Alabama, who chairs the Appropriations Subcommittee behind the proposed Title I cuts. Now, he's saying that it's a big program, they can afford to cut it, that they had a lot of funding from the pandemic that didn't get spent. What would you say when it comes to some of the places that they're trying to cut and the ripple effects that does have on working Americans when it comes to education and when it comes to childcare?
I would say simply, just because your budget is big doesn't mean you don't need it. We make the budgets big because there's a big need. We know how many children are in need of pre-school education. And that is something I should say we have always been about, but we have not always been about that. I happen to be from the state of South Carolina. I know what education was like in this country before those legislators back in the 1860s mandated free public education for everybody. And that says to me that that's a gentleman who would like to see us back into a mode in this country when only the wealthy and well-to-do got support for education and everybody else gets relegated to second-class citizenship.
And for a lot of the viewers who are wondering, they're looking at this governance, they're looking at the infighting between the GOP, this inability to really honor the agreement that came out from May. But then when you look at the approval rating for President Biden, it's in the low 40s. It's been sort of teetering in the high 30s to low 40s. Congress has a rating of about 17% according to the Gallup poll. And people are frustrated. There's inflation, there's high gas prices. With so much blame potentially to go around, what do you think that does for President Biden's re-election chances?
Well, I think President Biden is in a very good place for re-election. Just like I thought he was a good place to get elected back in 2020 when everybody told me he had no chance of getting elected. And he's sitting in the presidency now. I thought that we had a good chance of averting a so-called red wave that everybody said was coming in 2022. I don't remember a red wave ever coming. I don't know what's happening to the polling. I think that when you poll people, you ask them, are they satisfied? A lot of people are dissatisfied for various reasons. But these dissatisfied people are not willing to turn their government over to an autocrat. But that's what we are getting in this polling. So I'm not worried about the polling at all. I think this president is doing well. He is going to preserve the American dream for as many people as he possibly can. Those people who don't need his help, then they are not satisfied with the programs that he's proposing. He is going to do what is necessary to maintain the democracy going forward. Those people who are interested in autocracy, they are not going to support this president. But I think that the vast majority of the American people do believe in the American dream, and it should be available to everybody, do believe in a democracy, and we ought to continue our pursuit towards a more perfect union. And so he's going to be fine.
And I do just quickly want to ask you, because a lot of people are wondering just how long this shutdown is going to last, considering how far apart both sides are on this. Are we expecting what we saw with the 35-day shutdown last time over the border with former President Trump?
Well, I certainly hope not. And I think the American people can weigh in on this and prevent that from happening. I don't know if there was anybody would have said 6 months ago that we would see auto workers on strike getting more than 70% support from the American people, because people are now beginning to understand that there are forces in this country who would love for the greatness of this country to be confined for those who are the wealthiest among us, who have been handed down fortunes and want to maintain that for themselves. Those who could care less about people getting assistance to lift themselves up by their bootstraps. Those of us who are in tune with that are in tune with this president, and he's going to be fine for re-election.
Well, the American people are watching what we see play out with the governance here. I appreciate you taking the time to join us. Congressman Claiborne, thank you so much.
Thank you very much for having me.
All right, Akiko, back to you in the studio. Thank you.
Okay, Rochelle, thanks so much for that. We're going to check back in with you in a bit. Bond yields moving lower today after the Fed's preferred inflation gauge showed some signs of moderation. The personal consumption expenditures price index edged lower in August, pointing to progress in the Fed's fight against inflation. Yahoo Finance Fed reporter Jen Schomburger is tracking the data for us this morning. And Jen, the question everybody asks on the back of this is, what does this mean for the FOMC meeting coming up in November?
Good morning, Akiko. Yeah, the Personal Consumption Expenditures Index, or PCE as it's known, is the Fed's favorite measure of inflation. It is the primary gauge that the Fed analyzes for inflation, which is what makes it so important. So why is the Fed so focused on this particular measure? Well, for starters, it's a broader measure of inflation than other measures. For instance, it includes more data on healthcare, including Medicare and Medicaid. It also accounts for what consumers actually spend their money on every month, adjusting based on changes in spending. So, for example, if people decided that oranges were much too expensive that month and decided to switch to bananas, well, that's accounted for. And the Fed also likes to look at the so-called core measure of inflation that strips out volatile food and energy prices, which the Fed really can't control through their monetary policy mechanisms. Those are dictated more by global supply and demand. So that core number this morning clocking in below 4% for the month of August. Welcome news for the Federal Reserve, which has been looking for continued cooling trend in inflation. Akiko?
Yeah, we've certainly seen that relief reflected in market action so far today. Jen, we've been talking about the government shutdown, of course, the last day for Congress to pass a spending bill. We've got just over 24 hours to go here. But what would a shutdown mean specifically for the Fed?
Yeah, so this PCE number and other data that the Fed counts on that comes out and is collected from the government, everything from PCE to CPI, the jobs report coming up next week, that would all be suspended if there were to be a government shutdown. And that data would not resume collection until the government is reopened. So depending how long this government shutdown would last, assuming we do go into one, that means that Fed could enter the next meeting on November 1st, not having enough data to decide whether to raise interest rates or not. I asked Chair Powell about this at his press conference last week. He said it's too hard to say in advance what exactly we would do, but we would just have to, quote, deal with it.
All right, always keeping those options open. Jen Schomburger, as always, thanks so much for that.
Thank you.
Well, we've got much more of markets action ahead, as well as a breakdown of what a government shutdown could mean for you. We've got much more to come here on Yahoo Finance Live. We'll be right back. Well, the Fed's preferred inflation gauge, core PCE, headed lower in August, signaling progress in the Fed's fight against inflation. And it's a welcome indicator for investors bracing for a prolonged period of higher rates. Joining me now is Adam Turnquist, LPL Financial Chief Technical Strategist. Adam, it's good to talk to you today. As our Jen Schomburger said before the break, this is kind of the gauge that the Fed looks for, particularly because it does a good job of tracking where consumer behavior is headed. How much of this moderation that we saw, at least in this print, do you attribute to the Fed's action?
I think those lingering effects of the rate hikes are finally kicking into gear. You can see the progress that we've made with inflation here. If you go back even last year, a year ago, looking at core PCE, you were at 5.5%. Clearly, the trend here with inflation is the Fed's friend right now, with coming in below 4% today. Obviously, the market is welcoming that news as well. You can see a pretty big advance here off a key support level for the S&P 500. So I guess maybe a positive way to wrap up a pretty negative month overall for the S&P 500.
Yeah, that's an important thing to note here, given the choppy September that we've had. We're talking about core PCE, which is what the Fed looks at. But if you add in what happened with energy as well as food, we're talking a huge acceleration, energy costs rising more than 6%, at least in the month. How big of a concern is that for you when you think about the overall trajectory of the central bank?
Yeah, I think the overall move we've seen in energy, looking at WTI crude oil, rallying north of $90 a barrel now, certainly weighs on that headline data. The Fed has told us they look past that energy component, but as a consumer, we can't really look past it. It's something we pay for, whether it's in travel, whether it's when we fill up our gas tanks. So that's a real inflation that takes away from consumer spending. And we did see some of that data today as well. We had the revisions in the GDP print that were drastically dropped on Thursday, and then today's personal spending also lower. So that's starting to weigh, I think, as we look at the impact on inflation and those rate hikes as well, weighing on the consumer.
Looking at where sectors are trading today, energy, one of the big laggards, but of course we've seen a significant run up in those stocks because of oil inching closer to that $100 a barrel mark. How are you trading on that right now?
So we like energy at the sector level. We actually upgraded energy from a neutral to positive earlier this month, and for several reasons. First, just look at the energy components, those commodity components, and you can see WTI, again, breaking out from this bottom that's been forming for almost a year. Supply-demand dynamics there look constructive as well. So we think the path of least resistance for crude oil is higher. And then when you look at the sector overall, that's also starting to show some relative strength. And you can see it's outperforming over the last few months with the S&P 500. What's unique about energy, one, at the sector level, it trades relatively cheap to the market. So if you're looking for some value, it also has a dividend yield. And it's also powered by this expansion in breadth. So there's a lot of stocks participating in this rally. There's no magnificent seven within the energy sector. This is a broad-based buying pressure across the sector.
Even with that said, though, where would you advise clients to put their money? Are you looking at the oil majors? Are you looking at other players? Where in the energy sector do you think has the most value?
Good question. We like the E&P space within energy. We think that has a little bit more runway. It's showing better relative strength. Of course, there's a good dividend yield there. Put up really good free cash flows as well. Oil services is another spot within the energy space that's doing well. That's really been outperforming. However, we like the E&Ps probably as a favorite.
Bond yields pulling back a bit today on the back of that PCE print we got. But, we've been talking about 10-year hitting 15-year highs on the shorter end, the 2-year hitting highs we haven't seen in, 16 years or so. Are you increasing your exposure to fixed income on the back of that? How do you play it?
We like the bond market right now. We think it's a unique opportunity to capture and lock in some of these yields, especially on higher grade corporate, higher grade. If you look at mortgage-backed securities, we like treasuries as well. We don't think you need to dive into the high yield space to capture yield right now. So bonds are back, as our chief fixed income strategist likes to say. It's a little concerning from an equity standpoint when you see the 10-year breaking out above those October 2022 highs. Certainly had a major impact, I think, on stocks this month. So I think if we can see a little bit of a pullback here, or at least stabilization in interest rates, I think the equity markets would welcome that as we go into October.
Finally, Adam, we've been keeping a close watch on DC today, given that clock as we get closer to a potential government shutdown. The markets largely have been kind of shrugging it off, given where equities have traded in previous shutdowns. Is that a risk that you're watching at all, or is this a non-event when it comes to the market?
And when it comes to the market, I think it's a non-event. At least that's what history tells us. If you look at the last 20 shutdowns, average returns during the shutdown, pretty much flat. So coming out of a deal, the market tends to trade higher as we get through that level of uncertainty, but certainly makes a lot of headlines. I think it does weigh a little bit on overall sentiment in the market, but overall history, if it rhymes, it might not repeat, but it often rhymes. And I think when we look at this shutdown, it's probably going to be a non-event as it relates to the market.
Okay, certainly appears as though other investors agree right now. Adam Turnquist, LPL Financial Chief Technical Strategist. Good to talk to you today. Have a good weekend.
You too. Thanks.
Let's do a check of the markets sponsored by Tasty Trade. We are seeing the markets looking to at least end this session on an upbeat note, just over 90 minutes into the trading day. The Dow up 71 points, the S&P 500 up 25, and the Nasdaq up 137 points. We've got all your markets action ahead. Stay tuned. You're watching Yahoo Finance Live. More new tech out this quarter. The Fitbit Charge 6 is rolling out next week for $159, updating that current model with features to compete with the likes of Apple and Google, but at a lower price point. More on this. We've got Yahoo Finance reporter Dan Halley on the beat for us. Dan, I've got my Apple Watch on. Is it going to convince me to switch over?
Probably not. Really, the Fitbit Charge 6 is more designed for someone who's not looking for a full smartwatch. Really, doesn't want all of the rigmarole of constant notifications. It will get you notifications for things like phone calls and text messages, things like that. But if you don't want a deluge of notifications, then you might want to try something like this. It's also, by the way, got 7 days of battery life compared to the Apple Watches or Samsung Galaxy Watch or Google Pixel Watch, which usually tap out after about a day of use. So this is something that's meant for multiple days, that's focused primarily on the health tracking aspect. And Fitbit says that they have a 60% improved heart rate tracking capability on this. They didn't change the sensor per se. They've updated the algorithm that tracks this. So it'll work even better when you're doing strenuous activities, whether that's rowing, sprinting, things along those lines where there's a lot of jostling when it comes to your wrist. At $159, it is much cheaper than competing smartwatches, including Google's own Google Watch. The Google Pixel Watch. You'll remember that Fitbit was purchased by Google in 2021. And so part of this revamp for this tracker is the inclusion of Google software. That means you'll be able to get access to Google Wallet. So if you want to pay for things on the go when you're out for a run and don't have your credit card with you, you can just go up to any participating point of sale and just double tap on the button on the side and be able to pull up Google Wallet. It'll also give you Google Maps capabilities. Now, I spoke to Fitbit CEO James Park. This doesn't mean you're going to be able to get a full map on your Fitbit tracker, but it does mean that it'll get you turn-by-turn directions. So if you're plotting out a run beforehand, you add the route to your Google Maps, it will then provide you with turn-by-turn directions as you're going around. And, if you're going to a new city and you want to go see the sights on a quick run, that's something you can easily pull off with this capability. But, I got to say, for Fitbit, it really is interesting to see them continuing to put out the trackers. The big deal for the company is kind of the software that they have to offer. And that's probably why Google purchased them in the first place. They have Fitbit Premium, which captures all of your tracking information and provides you with things like new workouts. There's Fitbit's readiness score, which is a great feature that tells you whether you're ready for a full heavy bruising workout based on the amount of sleep you got in the prior day, the amount of exercise you did in the prior day. If you're not ready for that, it'll let you know that you should take it a little easier. And there's actually an electrodermal sensor on here that will also using the electrical resistance caused by sweat, tell you if you're stressed out. So if you're hanging out, you have a big interview maybe coming up with a boss, or I guess you're standing trial for some reason, you would be able to see that you're a little bit stressed from the actual tracker, and then it'll offer you the ability to do a mindfulness session, kind of take a couple of deep breaths and cool down.
Dan, I feel like I get that warning a lot on my Apple Watch to say, just take a deep breath here. But look, you've talked about the price point here. I mean, that is a big advantage for Fitbit. Are they making inroads in this space, though, when you consider how dominant those like Apple have been?
I think really the tracker market is still there. Obviously, it's not going to be exploding as much as something like a smartwatch would. The Apple Watch, as you said, is the dominant smartwatch in the world. Even though most people have Android phones. And the reason for that is because people who have iPhones are genuinely more affluent, so they're able to afford them. Most of the world is using lower cost Android phones, and that's really just the reality of it. So a tracker like this could be very good for people who are looking to get some kind of wearable, get some health information. I think, when it comes to Fitbit, they work now, hand in hand with Google. So they have the Google Pixel Watch, which had come out previously. And so their Fitbit Smarts are built into that as well. So I think it's important to keep in mind that while they still have the trackers going, they also have the software now kind of pushing its way into Google's other products. And that's going to be a way for, obviously, Google to benefit as well as Fitbit.
Okay, Dan Alley, always with the very extensive reviews. Always appreciate it, Dan Halley. Thanks so much for that. Well, we've got Rochelle Akufo standing by at the Rotunda still with a guest with her. Rochelle.
That's right. I mean, you were talking about stress, certainly plenty of that to go around as we're counting down to what could end up being the government shutdown, most likely scenario as we're seeing at this point. I want to bring in my guest, Caitlin Emmer, Politico budget and appropriations reporter, as we're trying to see what's happening with the stopgap CR. Some of the provisions, obviously, including concerns at the border. What sort of momentum are we seeing here, and what sort of position is Speaker McCarthy in right now?
Right. Well, Speaker McCarthy just had a press conference where he essentially dared Republicans to, vote in favor of shutting the government down today or vote in favor of securing the border. That is sort of like a misnomer, right? His continuing resolution, which would keep the government open until Halloween and also includes, desired Republican border legislation, has no chance of success in the Senate and has no shot at ever reaching President Biden's desk and becoming law. So really the exercise that Speaker McCarthy is undertaking today moves us no closer to averting a shutdown. Meanwhile, you have the Senate operating on a separate track. They're talking about amending their own CR to add some certain border legislation, which is going to be a very difficult and ambitious lift. So we're all but headed for a shutdown in less than 48 hours, and it's sort of like the slowest moving shutdown ever, right? I mean, it feels like we're sort of headed to this place and no one is really doing anything very substantial to stop it at the moment.
So then, when people are wondering what the end game is here, when you have these sort of dead on arrival proposals being pushed through, what is the end game for some of these GOP holdouts?
I mean, I think it's about leverage, right? I think there's a question also of whether Speaker McCarthy gets to keep his gavel when all of this is over. Earlier this year, you had the debt ceiling talks in which Speaker McCarthy relied on Democrats to avoid an economic catastrophe. That happened, and in this case with a government shutdown, while so many people would be affected by going without pay or being furloughed, really terrible consequences for federal workers. I mean, the stakes are a lot lower. So it really gives these, Freedom Caucus members a chance to assert themselves, say that their demands have to be met, that they're not going away, that, these are the spending cuts that we have to see. And really, I mean, it's all up to Speaker McCarthy in terms of what he decides to put on the floor, whether he ultimately relies on Democrats to help keep the government open, reopen the government eventually, and after that, I mean, whether or not he really gets to keep his gavel.
And there have been some reports simmering behind closed doors about conversations about whether he should keep his gavel, depending on how this goes. How real is that risk, and what would a succession plan look like, considering how hard it was even for Kevin McCarthy to get this spot?
I think the risk is very real at this point. We've seen a number of stories, in the last 24 hours, some written by my own colleagues, on the Congress team at Politico about what that could potentially look like. And the interesting thing, I think, about that discussion at the moment is when you're talking about a government shutdown, right, some folks are sort of like, well, what are the Freedom Caucus people, demanding? Like, their demands aren't clear, no one's really sure what they're demanding. Same sort of thing, I think, applies here, where there doesn't seem to be a coalescing around who would succeed McCarthy. And really, you're just going to be putting another person in McCarthy's exact same position. I don't think anything really substantively would change, you know what I mean? If we had to replace McCarthy with somebody else, it would be still an untenable political position to be in, where you have a few members who can be very, very disruptive when they want to be.
And obviously, if you're someone watching this, you're seeing a lot of this infighting, still trying to get clear on what it is exactly the GOP wants versus what was agreed upon in May. What does this do in terms of the governance? When people are looking at how the country is being run here, when they're already struggling with high gas prices and inflation, and then seeing this infighting about something that was essentially already agreed upon back in May?
Right, and that's a really good point. The debt ceiling legislation that passed back earlier this year should have paved the way for this government funding process to be relatively smooth, because it set overall funding levels that these spending bills could have been written to. But of course, House Republicans decided to undermine that agreement by writing to much lower levels, which they say that they are fully allowed to do, and they are. It's just not typically how things work. So I think people start to see the continuing, fighting over keeping the government open and this idea of are we going to shut down or not, and it definitely erodes public confidence in governance. I mean, you have so many federal workers just in the Virginia, Maryland, D.C. area that would be affected by something like this. I think now, when you're thinking about a shutdown, you really have to look at, okay, what is the next forcing mechanism to make sure that this doesn't go on for, more than a month like it did during the Trump administration? And that would probably be the first point sometime in mid-October when payroll would be processed and people would be missing that first paycheck. So certainly that's not a milestone that anybody wants to reach here, but I think definitely public confidence in Congress and our government suffers when this is a fight that we have every single year.
And when you look at how many shutdowns we've had, I believe it's 22 since 1976, obviously with the last being the longest at 35 days over that border wall. Before that was over the Affordable Care Act under former President Obama. What is the solution here so that we don't keep ending up in this same position? Are there any really viable ways forward that don't end up having us in the same position?
I mean, certainly. I think that's a great question. There are efforts in Congress to pass legislation that would end shutdowns forever and just make sure that if there is, a lapse in appropriations, that instead, government funding is just automatically extended and we don't have to go through this entire process. But it sort of remains to be seen whether or not there's actual real serious traction on something like that. I think eventually that is a discussion that needs to be had probably pretty seriously, especially in the Senate. It seems like, when this Senate CR ever comes up for a vote, there is anti-government shutdown legislation that is expected to get an amendment vote. It will require 60 votes, which is somewhat of a high threshold, so it'll be interesting to watch what happens there. But certainly this is not a fight that people want to keep having over and over and over again.
Indeed. But I appreciate you taking the time to join us. Caitlin Emma from Politico, thank you so much for your time.
Thank you.
All right, stay with us on Yahoo Finance. More coming up after this.
The UAW is expanding its strike to 2 additional plants this morning. The union specifically going after Ford and General Motors, with 7,000 additional workers set to walk off the job in the next hour. Stellantis was spared this time, though, with UAW President Shawn Fain saying the car maker has made, in his words, significant progress on key issues. 3 weeks into the strike, the economic impact is starting to ripple beyond the big three and the auto space. Let's bring in Wedbush Managing Director and Senior Equity Analyst Dan Ives with a breakdown here. Dan, I'm looking at the stock moves of the big three and not a whole lot of movement on the back of the latest announcement here. How big of a hit is this, or does this intensify in any way compared to where we've been the last 2 weeks?
Well, look, I mean, this is, if you looked up in the dictionary debacle, there'd be the UAW strike. That's what you'd see right now. And I think for the street, it's not about the next quarter or two. It's about what this does to the EV strategy. And I think this is just, it's which poison do you pick, right? Because if they accept this deal, GM, Ford, I mean, I believe this would significantly impair their EV strategy for decades to come. So that's why right now they're going to continue to fight this in this cage match versus UAW and FAN.
Let's look at some of the sticking points here. We start with the benefits, specifically looking at what that means from a cost perspective. We got reports yesterday that the UAW has come down from its initial request of a pay increase of more than 40%, but we're still looking at roughly 30, maybe in the high 20s, where they want it to be. What does that mean from a cost perspective of an EV to the consumer?
Yeah, because ultimately the consumer is going to have to pay this. I mean, it's going to get passed down, right? And I think if you look at the current deal, we think $3,000, $4,000 to $5,000 per vehicle. That would be the incremental cost. If you go down to call it mid-20s, that's something that's maybe digestible, where, you know, we're talking $1,000, $1,500. But look, this is the big issue here is foreign automakers, and especially Tesla. I think right now Tesla is champagne on ice, because this was going to be the lingering competition that's gone after Tesla. And I think the frustration is to watch someone like Mary and the team build this brick by brick for years to get to this point. Now the torpedo hits their strategy.
Do they scale back their strategy as a result? I mean, let's take that argument you just made, $1,000 additional, if the car makers are able to move things in their direction. I mean, we're still talking about cars out there like a Kia, Tesla, that already have a cost benefit because they are selling at a cheaper price point. You add in the government incentives into that. Does that prompt the big three to say, look, maybe we need to scale back our ambitions so at least from a cost perspective, we can still compete in the market?
I disagree. I mean, to that point, I know someone raised it. They have to dive into deep end of the pool on EVs. I mean, this is the future. This is, when you look at how GM's built everything from Ultium and the battery technology, I mean, they've built what I view as potentially a transformative strategy in Detroit. I think Farley obviously has gotten Ford in the right direction as well. They cannot take a step back here. I mean, that's why right now, this is going to be a heavyweight boxing match, because they understand that is going to be the strategy. But the UAW, they're going to have to play ball in terms of some negotiation here to get a deal done. Otherwise, this is going to be a long and nasty few months.
What does it mean from an adoption standpoint? Does this change the timeline at all? Do consumers essentially just go where the market is, where the prices are lower, even with this strike in place? In other words, if they were looking at a GM or Ford, prices go higher, let's say, do they just sort of switch over to a Tesla or a Kia or a Volkswagen?
Well, that's the biggest worry, because once, if you or whoever, their first EV, no different than an iPhone. I mean, the chances that they're going to stay within that sort of company and, you know, from a buying behavior decision is pretty high. The biggest worry here is that the longer the strike goes on, this goes on 4 weeks plus 6 weeks, it's an absolute Friday the 13th, a nightmare on Elm Street, because then the EV strategy for 2024 really then at that point starts to move out, potentially 3-6 months. They've missed a window. That's why right now this is all like watching a slow moving car crash.
And that movement still continuing here with the UAW once again expanding that strike today. Wedbush Managing Director and Senior Equity Analyst Dan Ives, as always, thanks so much for joining us today. And we've got more markets action ahead. Stay tuned. You are watching Yahoo Finance Live. Well, we are continuing to keep a close watch on Capitol Hill this morning as a government shutdown looms with little positive news coming out. The federal government will have to make significant progress in the next few hours with tensions escalating within parties, between parties. Is there a glimmer of hope where we can avoid a shutdown? And what could happen on Monday when the impacts of a decision will finally be seen? Let's bring in Mark Morial, former mayor of New Orleans and National Urban League CEO and president, to discuss. Mark, it's always good to have you on the show. As somebody who is not a part of this D.C. inner circle among the lawmakers, if you will, how are you watching this move towards a shutdown?
Well, thanks for having me. I think, like all Americans, we're intently paying close attention to the discussions and the deliberations in Washington. We have to say at the outset, a shutdown is not necessary. Historically, what Congress has done, if they can't affirm a budget deal, they'll pass a continuing resolution, which means a temporary extension of the existing budget. And that is what could be done in this instance to avoid the pain, the devastation, the human toll, and the human impact of a government shutdown, which would mean military personnel not getting paid, federal workers not getting paid, people who receive government benefits not receiving their checks. Think about those three things and the impact on the retail economy, on the ability of people to pay rent and mortgages, pay for food, or take care of their children. The impact goes beyond those directly impacted if we have a shutdown. Fact and point, the last time we had a government shutdown, it cost the economy $11 billion, of which $3 billion were never recovered. So this is not needed. It is not necessary. And we can't allow a small group of selfish, narcissistic performance artists parading as politicians to hold the nation hostage.
I mean, you hammer home the real life impacts that we're likely to see, beyond DC. specifically looking at the communities that the National Urban League serves, what are the services that could be stopped that you're most concerned about right now? What does that impact look like?
So one would be certainly the impact on federal workers. Think about the many, many, many Americans, even in your local community, who work for the federal government. Think of the many, many people who work for companies that do business with the federal government. So that would be a direct impact that would touch all 50 states and every community in the nation. Then there's the SNAP or food stamp program, which is vital to food security for so many families. Food stamp recipients are of all races. They are of all genders. They are in all 50 states, and they are the most vulnerable Americans. Some who are very poor, some who are poor because they're transitioning between jobs after having been laid off. That community can be detrimentally impacted. And then certainly there are those who may receive housing vouchers or Section 8 vouchers who rely on that to pay their rent. They could be directly impacted. So our communities, the most vulnerable Americans, certainly will bear the greatest brunt. But let us be clear, they are not the only ones who feel the impact of a government shutdown.
How is the Urban League working with some of these communities you just highlighted to provide a contingency plan? I mean, the hope is there is no shutdown, but if that's the case, there's really nothing that points to what that timeline looks like right now.
So the most important thing we can do is join with those who are advocating, those who are pressuring, those who are loudly saying to members of Congress, be responsible, do the right thing, particularly that small group of right-wing members of Congress who are provoking this shutdown by holding the political standing of Speaker McCarthy hostage, if you will. But secondly, we know that if there is a shutdown and people are in pain, they will come to Urban League offices all across the nation. Our ability to serve that onslaught is limited. We administer programs for the federal government. So we obviously are concerned that those programs and those services may be interrupted. We will do everything we can to assist and sustain communities, but make no mistake about it, millions and millions and millions of Americans could see their fortunes directly impacted in the event that there's a shutdown.
And finally, Mark, you talked about the SNAP program is one that could really affect some of these communities. We're talking about underserved communities that have already been hit hard because of the higher prices that we have seen. To what extent does something like this exacerbate the challenges that are already in play?
In some communities, people have been hit by natural disasters, floods and hurricanes. In other communities, people have been laid off or transitioning between jobs. In other communities, just poverty and the difficulty of making ends meet mean that people need the support of the SNAP or the food stamp program in many instances to feed children or to feed seniors or to provide support for the most vulnerable people. They will be impacted. Think of this. For us, food is not a nicety. It's an absolute necessity. Why would anyone hold ensuring that Americans are fed, that children are fed, that families are fed, that seniors are fed hostage for a petty political battle?
Mark Morial, former mayor of New Orleans and CEO and president at the National Urban League. It's good to get your perspective today. Appreciate it.
Thank you for having me. Thanks.
Let's do a final check of the markets before we let you go. We have seen the Dow dip into the red in the session here, down about 57 points. The S&P 500 up 7 and the Nasdaq up 84. We are, of course, continuing to watch shares of the big three as the UAW expands its strike, specifically targeting Ford and General Motors, although we are seeing Stellantis, who is kind of spared in this latest expansion, down just slightly, about 0.3%. And of course, we've got Rochelle on the Capitol for us because we are counting down to see whether, in fact, this government shutdown can be averted. Rochelle, we had that clock going at the bottom of the screen, one day and 12 hours, just a little more than that. left to go. Certainly a lot of people are going to be watching to see whether in fact we can avert that. As Mark Morial pointed out, if in fact there's a government shutdown, real life impacts certainly will ripple across the country. That does it for Rochelle and I in this hour. Thanks so much for watching. We'll see you right back here on Monday at 11 a.m. Eastern.